Chapter 4. More on reversal patterns. Now that you are familiar with the primary candlestick reversal patterns, this chapter will solidify your understanding of how they form. It will also point to some factors that may influence the occurrence and performance of the signals. The pattern must have something to reverse. It matters where a candlestick reversal pattern forms on a chart. In order for a reversal signal to have significance, price must be moving in a direction, either up or down, prior to the formation of the pattern. Bearish reversal patterns are relevant if they form after an upside move. Conversely, bullish reversal patterns are important if they form after a downside move. As a general rule, the reversal pattern should form at or near the end of the directional price move. If price is moving sideways, referred to as consolidation, and a reversal pattern forms within that congestion area, it has little or no significance, especially if price has been moving sideways for several days already when the pattern forms. If the stock was in a short-term overbought or oversold condition prior to the consolidation, that overextended condition has already been alleviated by the sideways price action. In other words, there is no longer a move to reverse. Price has already changed direction. Example: Figure 4.1 shows a daily chart of OSI Pharmaceuticals Inc. (OSIP). On October 29, 2007, a bearish hanging man formed during the session, following a very long bullish candle. This bearish signal was meaningful because there was a price advance to reverse. Price changed direction, moving sideways for several days following the hanging man. On November 7th, a bearish shooting star formed. However, price had already been consolidating for several days prior to the formation of the shooting star, so it had little significance as a bearish reversal signal. What the shooting star's long upper shadow did show us in this scenario was a failed breakout attempt. Price had rallied intraday above the consolidation area, but the bulls were not able to sustain the rally, and price closed back inside the consolidation area, leaving just the upper shadow. The consolidation shown in Figure 4.1 was very tight. I refer to this type of shallow sideways movement as basing, according to Nissen. The Japanese refer to it as a box range. Another type of consolidation occurs when price moves sideways, but makes identifiable price swings across the consolidation. See Figure 4.2. This price action is called a rectangle. It may also be referred to as a trading range or a horizontal channel. The short-term price swings across the rectangle often find resistance near the ceiling and support near the floor. You may see candlestick reversal patterns form at those turning points because there is a short-term trend to reverse. On the daily chart of Commercial Metals Co. (CMC), in Figure 4.2, the stock was trapped in a trading range from May through July 2007. Several of the short-term swings across the rectangle ended with candlestick reversal patterns as follows. 1. May 9th, a bearish hanging man, 1, created the first peak in what eventually evolved into a trading range. 2. June 4th, a doji, 2, formed as the May 9th swing high was tested. 3. June 13th, a bullish hammer, 3, which was also part of a bullish harami, formed as the May low was tested. 4. June 27th, another bullish hammer, 4, formed at what is now clearly defined as support. 5. July 16th, after breaking out just above the ceiling of the rectangle, a bearish engulfing pattern, 5, pulled price back down, leaving a false breakout. False breakdowns through support may also occur. Such false moves are common and are frustrating for unsuspecting traders. In summary, a key component of analyzing candlestick reversal patterns is to make sure to evaluate the price action that preceded the formation of the pattern. There must be at least a short-term price move to reverse in order for a reversal signal to have validity. Factors that may strengthen the reversal signal. Listed below are some factors that may increase the likelihood that a change in price direction will follow a reversal pattern. The stock is overbought when a bearish pattern forms, or oversold when a bullish pattern forms. Oscillators are technical indicators that can measure these overextended conditions. Overextended conditions and the use of oscillators are detailed in Part 2. The pattern follows a steep move. Significant gains can be made during a swift move, and traders will be protective of those gains. Therefore, these events are very vulnerable to profit-taking. If price starts to reverse, many stops will trigger. The result is often a fast and sharp decline after a bearish pattern or advance following a bullish pattern. The pattern does not occur much on the stock. If the pattern forms frequently, it may not have a significant impact on price movement, unless, of course, when it does form often, it usually follows through well. Otherwise, if a pattern forms often, the emergence of yet another of the same pattern may not be very significant. The pattern forms at a strong support level, bullish pattern, or resistance level, bearish pattern. Several such chart examples were provided in Chapter 3, and more discussion on support and resistance is included in Part 2. Broad market environment. It is important to pay attention to the broader market. If a broad market rally or sell-off occurs, many stocks will rise or fall in kind, at least for the short term. This can have an influence on the success or failure of reversal patterns. It can also impact how stocks respond to support and resistance levels. When the broad market rallies strongly, you'll see many stocks break up through resistance. Conversely, when the broad market melts down, many stocks will break down through previously strong support levels. The market environment may also influence the type and number of reversal patterns that form on the charts of stocks. At the time of this writing, July-August 2007, the broad market was experiencing a correction. One of the primary drivers was the problems in the subprime mortgage market, which hit many financial stocks hard. It sent a ripple through the markets. The result was a dramatic increase in volatility. Day after day, the Dow Jones Industrial Average experienced triple-digit advances or declines. See Figure 4.3. On many days, the intraday action resembled a roller coaster ride. The S&P 500 index fared even worse, since its component list includes many financial stocks. During that volatile period, many candlestick lines and patterns formed on charts, which echoed the market's instability. Long shadows were common, highlighting the wide price swings intraday. Although reversal formations were prevalent, their signals were very short-term and not always reliable given the unsettling environment. It was an exasperating time for investors as they worried over their portfolios. However, it was a profitable time for experienced day traders and swing traders who understood how to benefit from the volatility. Example: on August 16, 2007, a hammer with a very long lower shadow formed on the daily chart of the Dow Jones Industrial Average, Figure 4.3. The body was so small that some chartists would have interpreted it as a dragonfly doji. Regardless, it was a bullish signal. And, in fact, the 3 days from August 15 to 17 formed a variation of a bullish morning star. Hammers also formed on the S&P 500 and Nasdaq Composite Index charts on August 16. Given that, just imagine how many hammers, dragonfly and long-legged doji, and other bullish reversal patterns formed on the charts of individual stocks. Remember that this broad market decline was largely spurred by credit concerns. Therefore, many financial stocks declined sharply. The long candles and long shadows that formed on their charts illustrated the increased volatility. Example: Figure 4.4 shows a daily chart of Morgan Stanley, MS, a brokerage stock. Note the dramatic increase in volatility, circled, that reflected the troubles in the financial sector. Reversal patterns may not reverse a trend. Traders should be cautious of the word reversal. Although the candlestick patterns introduced in Chapter 3 are referred to as reversal patterns, and they do have the tendency to be followed by a change in the direction of price, it does not mean the patterns will be followed by a trend reversal. A trend reversal is a significant event. Price would have to retrace at least 2/3 of the prior trend before it technically would be deemed a trend reversal. Moreover, these patterns warn that price may reverse the current direction, at least temporarily. When a bearish reversal pattern forms after an upward move, it signals that price may change direction from up to down or sideways, and vice versa for a bullish signal after a downward move. If a significant reversal does not follow a candlestick signal, it does not mean that the candlestick pattern failed. Candlestick reversal patterns provide primarily short-term signals. If a pattern is followed only by a pullback or period of minor consolidation, the signal was still successful at calling a change in price direction. No matter how strong a reversal signal, or how ominous its name or appearance, it does not dictate how significant the change in price will be, the magnitude. Candlestick patterns do not provide price targets, nor do they predict how long a change in price direction will last, the duration. An entire chapter in Part 2 is devoted to the discussion of trend analysis. Once you've completed that segment, you'll have a better understanding of the role of candlestick patterns within the bigger picture of price movement. Failed reversal patterns. Traders should not expect that every reversal signal will be successful at calling a change in price direction. Reversal patterns can and do fail. To my knowledge, nothing in technical analysis works 100% of the time. However, it is better to respond to a signal that turns out to be false than to ignore a valid one. Price should change direction shortly after the emergence of a reversal pattern. If instead, price immediately moves again in the direction of the trend, the signal has been negated. For example, if a bearish hanging man forms and price fails to close below the hanging man's real body and instead moves higher, the hanging man signal is no longer valid. If price is still overextended though, the stock is vulnerable and additional reversal signals may follow. Refer back to Figure 3.27 in Chapter 3 for an example. On that chart, a hammer formed during a sharp decline, but price continued lower in the next session, negating its bullish signal. 2 days after the hammer's failed signal, a long-legged doji formed at support. Buyers stepped in at that level, and many shorts covered, stopping the stock's fall. The probability of follow-through can be enhanced by combining the reversal signals with classic Western technical analysis, which is the focus of Part 2. Reversal pattern psychology. One of the most important aspects to absorb when studying the reversal patterns is the psychology behind their formations. Rather than just memorizing the look of the pattern and its name, try to really understand how the price action unfolded during the sessions that form the pattern. At the close of market, the daily bar provides a snapshot of the day's battle, but if you view the intraday timeframes, you'll see the details of the battle. Reference was made several times in Chapter 3 to the bulls taking control from the bears intraday, or vice versa. The discussion that follows demonstrates how that transfer of power might occur. Example: Figure 4.5 shows a daily chart of Peabody Energy, BTU. On August 6, 2007, a bullish hammer formed after a price decline. A short covering rally occurred in the days following the reversal pattern. However, that rally actually began intraday on the day the hammer formed, as you'll see on the 5-minute chart in Figure 4.6. Figure 4.6 shows the August 6th intraday price action that created the bullish hammer on BTU's daily chart. The following commentary steps you through the day's price action as it appeared on a 5-minute chart. The numbers correspond to the numbers on the chart. 1. Price gapped up open and rallied for the first 5 minutes of trading. 2. Price reversed direction and declined for 15 minutes. 3. Some buying pressure occurred over the next 2 bars, temporarily stopping the fall and putting in the first bottom. 4. Price turned down again and tested the bottom at 3, which did not hold. 5. The decline continued for several more bars. Price turned up again for 5 minutes. That bounce put in the second prominent bottom of the day. 6. Price turned back down and tested the new low at 5. This time the bottom provided support and price rallied. 7. After each swing up, price pulled back some before moving higher. 8. Price pulled back deeper this time, correcting part of the uptrend before continuing higher. 9. The price parted. Price continued its series of upward intraday swings, followed by minor pullbacks until the end of the day. From this intraday price action, you can see where the bulls were successful at taking control from the bears. The bears dominated most of the price action between numbers 1 and 5. This is obvious from the price direction, but also by the fact that most of the price bars during that time were bearish candles. Between numbers 6 and 9, the bulls were in charge and were able to push price back up to close slightly higher than it opened. The intraday decline that was followed by a reversal is what created the hammer's long, lower shadow that you see on the daily chart. If you were to press all those intraday price bars together, you'd see how they translate into a hammer with a white real body on the daily chart. You can learn a lot by examining the daily candle and then shifting down to a lower intraday time frame to see how that daily candle was created from the intraday price movement. If your intention is to swing trade the markets or become a day trader, understanding these concepts will help you develop your trading strategies. It may make a significant difference on your profitability. Even if you intend to hold most of your positions longer term, the weekly and monthly charts break down to lower timeframes as well, so the lesson is still applicable. Beware of thin markets. Caution: beware of thinly traded stocks or markets. Candlestick signals are much more reliable on stocks that trade adequate volume than they are on illiquid issues. Volume will be discussed in Chapter 6, end of Chapter 4. Chapter 5. Tails. A candlestick line's upper and lower shadows represent the price extremes, the high and low, of the trading session. Although the Japanese do put a lot of emphasis on the candlestick's real body, the shadows can also tell us a lot about the psychology of market participants. Therefore, shadows play an important role in chart analysis. The following discussion specifically addresses the formation and implications of long shadows. Long shadows are often called tails. As you learned in Chapter 3, there are several reversal patterns that include tails in their formation. For example, the hanging man and the shooting star. Not every candlestick line that forms a long shadow will meet the criteria of a specific candlestick pattern. Regardless of whether the formation has a name or not, it is important to understand the message behind a tail. Long upper shadows are bearish shadows. Figure 5.1. The presence of one or more bearish shadows after a price advance demonstrates that the market is reaching for a top. There is not enough demand at higher prices to continue to propel the stock upward, at least for the short term. This is especially evident near a resistance area or in an overbought condition. The tails indicates that the bulls are taking profits and bears are stepping into short positions. The presence of long upper shadows on a standard bar chart can be deceiving. They might come across as bullish since price may still be making higher highs and, in some cases, higher closes. The candlestick line makes it easy to see, though, that price has closed well off its high. The inability of the bulls to sustain the intraday rally and close nearer the high is actually a bearish sign if it occurs after a price advance. Long lower shadows are bullish shadows. Figure 5.2. The formation of one or more bullish shadows after a price decline, especially near support or in an oversold condition, shows us visually that the market is reaching for a bottom. In this case, the tails indicates that lower prices are being rejected. The bears are covering their short positions and bulls are stepping into long positions. Tails at support and resistance. The presence of one or more tails at or near an area of support, bullish shadows, or resistance, bearish shadows, is fairly common. Experienced traders pay close attention to visible barriers on the chart and often execute trades near those points. Support and resistance is discussed briefly here and is covered in more detail in Part 2. When a stock that is rising encounters resistance, many traders use that barrier as a target to exit long positions. In addition, bearish traders may enter short positions near a resistance area in anticipation of a downside move. Once a decline begins, it may be more difficult for them to borrow the shares to sell short. Price may retreat from resistance, leaving a single tail, or there may be two or more tests of resistance in a short period of time. The tail indicates that the bulls were able to rally price, pushing it up to resistance or even above it during the session. However, they were not able to sustain the rally, and the stock closed well off its high. Example: Figure 5.3 shows a daily chart of Conway Inc. (CNW). On April 25, 2007, a gravestone doji formed the April high. 1. Price retreated and then settled into a horizontal trading range for several weeks during May. Price rallied up again at the end of May and tested the April high. A bearish shadow formed on May 31st, a shooting star, 2A, and another on June 1st, a doji, 2B, as resistance was tested. Auction. Higher highs were made on those 2 days, which might appear to be bullish if you were viewing a standard bar chart, and if you were not aware that a prior peak, the April high, may act as resistance. On June 1st, 2B, price actually broke out just slightly above the April high intraday, but closed below it, resulting in a failed breakout attempt. Price declined for several weeks during June. Another uptrend in July took price back up to that visible resistance area where, once again, bearish shadows formed. On July 16th, a bearish shadow formed, 3A, and back-to-back long-legged doji formed on July 18 to 19, 3B and 3C. On July 18th, 3B, price broke out above the resistance area intraday, but again the bulls could not sustain the breakout, and price closed well off its high. These long-legged candles show the violent tug-of-war that occurred intraday between the bulls and bears. The bulls finally gave up, and price turned back down. A very strong and visible ceiling, dotted line, is now seen on the chart. At some point in the future it may be broken, but until that time, you can bet that traders will react every time price approaches that area. The 3 parallel peaks that formed the April, June, and July tops on the chart of CNW in Figure 5.3 sets up a larger bearish Western triple top pattern. Long before the triple top was known in the Western Hemisphere, the Japanese had recognized it and named it the 3 mountain top. If the center peak is noticeably higher than the peaks on either side of it, the pattern is called a head and shoulders top in Western analysis. The Japanese name for a head and shoulders top is a 3 Buddha top, whereas the candlestick reversal patterns discussed in Chapter 3 provide primarily short-term signals. These larger triple and head and shoulders tops have more significant implications and may be followed by a trend reversal. Example: Figure 5.4 shows a daily chart of Coherent Inc. at COHR. An intermediate term uptrend that started from the March 2007 low ended on April 17th with a bearish dark cloud cover pattern. Price then declined back to the March low, dotted line, reversing the entire uptrend that occurred during March to April. On May 16th, as the March low was tested, a bullish hammer formed. The hammer's long tail shows us that the bears used that visible support area to cover short positions, and the bulls were willing to step into long positions. The bears were able to drive price down intraday to near that support area again during the 3 trading sessions following the hammer. However, the support held up and a rally ensued. A single test of support may occur, leaving one bullish shadow, or there may be more than one test of support. If there are several bullish shadows, it shows that the bears are able to push the stock lower during the day, but the bulls step in each day at or near the support level and push the price back up. Summary: at the end of a price advance or decline, the emergence of one or more bearish shadows, advance, or bullish shadows, decline, is an indication that the stock is attempting to put in a top or a bottom. This action is often followed by a price reversal or a period of consolidation. Tails in overbought or oversold conditions. Although it is common to see tails form when price approaches visible support and resistance areas, you'll see plenty of tails form where there is no visible barrier on the chart. Price need not be near a strong ceiling or floor for a tail to form. Price may simply have moved too far too quickly in one direction, causing a short-term overbought uptrend or oversold downtrend condition. Overbought and oversold conditions are discussed in Part 2. Just remember that when you see a tails form, you should be prepared for price to move in the opposite direction of the tail. Price may reverse the direction of the trend, or at least consolidate for a period of time. End of Chapter 5. Part 2. East meets West. Chapter 6. Price, Volume, and Volatility. Learning to recognize and interpret the candlestick lines and patterns is the first step, albeit an important one, on the path to putting candlesticks to work. And the knowledge you have already acquired in Part 1 should serve to dramatically improve your chart analysis skills. There is plenty more to be learned, though, in order to really master the power of candlestick charting. It is time to blend them with Western technical analysis. After you finish reading the next few chapters, you will have the additional tools you'll need to evaluate candlesticks in the context of the broader chart landscape, which can dramatically enhance their effectiveness. In the introduction, it was suggested that once you learn candlesticks, you may look at a standard bar chart and feel that it is incomplete. The same is true of combining Eastern candlestick charting with Western technical analysis. Once you learn how to put the two together, you may find that trying to analyze candlesticks without the aid of the bigger picture feels incomplete. An introduction to Western technical analysis begins with learning about the roles of price, volume, and volatility. Understanding these elements is crucial to successful chart analysis, stock selection, and trade management. Advanced traders who are already familiar with these concepts may elect to skim through this chapter or bypass it. However, traders who are developing their Western technical analysis skills should be aware that each chapter in this book builds upon the prior chapters, so it is best to read them in order and to spend adequate time digesting each one. Price. Price is the king of the chart. It is the purest measure of market sentiment. Price action is a manifestation of the combined psychology of all market participants, it tells us. It tells us the perceived value of a security at a given time. Price action provides the setups that we trade. There are numerous price setups for traders to choose from. Is priced. For example, candlestick patterns provide setups, as do classic Western bar and chart patterns, such as key reversals and head and shoulders patterns. A setup by itself cannot make you money. However, a strategy for trading it can. A trader may achieve consistent success by learning to recognize one or more price setups and devising a profitable strategy to trade the setups. A strategy should seek to enhance profits while limiting risk. Many novice traders get caught up in looking for the perfect technical indicator and neglect to put sufficient emphasis on price. It is more effective to learn how to evaluate the price action and use indicators as complementary analysis tools. When an aspiring trader points out an indicator signal to me, such as an overbought or oversold oscillator, and asks if I would execute a trade, I respond, "It depends on what is happening with price." I do not enter or exit a trade based solely on a signal from an indicator. Think of technical analysis as a big toolbox. Just as candlestick charting is one tool, indicators are another type of tool. Successful trading results from employing a set of tools rather than using each one in isolation. Many technical indicators are derived from price. Moving averages are calculated by averaging the price of a stock over a designated period of time, for example, 20 days. Oscillators are a group of indicators that measure the momentum of price. These indicators are discussed later in this book. Technical indicators can be very useful. However, it is still the price action itself that confirms or invalidates an indicator's signal. Part 1 of this book was devoted almost entirely to the discussion of price. The candlestick lines and patterns are formed from the open, high, low, and closing prices during a trading period. The candlestick reversal patterns must follow a directional price move in order for their signals to have significance. There is still plenty more discussion to come on price movement, as you'll see in chapters 7 through 9, which cover trend analysis, gaps, support, and resistance. But first, let's bring volume and volatility into the mix. Volume. Volume is second in importance only to price as a technical analysis tool. Volume's role in chart analysis will be referenced many times throughout this book. So far, you have seen how it may play a role in the formation of certain candlestick patterns, as discussed in Chapter 3. Volume provides a measure of the level of activity by market participants in a specific stock or trading instrument. Every share of stock that changes hands between buyers and sellers serves to increase the volume for that trading period. The most commonly quoted time period for volume is daily, but it is also tracked for higher time frames, such as weekly, as well as for each intraday time frame. In addition to being tallied for individual stocks, volume is also measured for entire markets, such as the New York Stock Exchange, NYSE. In the futures and options markets, volume is represented in the number of contracts traded rather than in shares. Displaying volume on the chart. In addition to price data, vendors of charting software also supply volume, and they may offer various ways to display it. I use the following displays of volume in the Telechart platform. See Figure 6.1, Volume in Shares. A field that displays the bar volume is inserted in the data line above the chart. The bar volume indicates the number of shares traded for a given period of time. For instance, during a daily trading session. In most charting programs, volume is displayed in hundreds, so you'll need to mentally add 2 zeros to the end of the number. Example, Figure 6.1 shows 2,807 shares traded on August 21, 2007 for Advent Software Inc. ADVS. Add 2 zeros to the end, and you can see that 280,700 shares were traded that day. Average daily volume A field is also inserted in the data line, showing a percentile ranking for average daily volume over the last 90 days. This ranking provides a quick gauge of the stock's liquidity over the past few months by indicating how heavily the stock is traded compared to all other stocks listed on the major U.S. exchanges. The lower the average daily volume, the more thinly traded the stock. Example, in Figure 6.1, the number 62 in the data line indicates that Advent Software currently trades more volume than 62% of stocks. Most of the stocks that I trade rank in the 50 to 99 percentile, which equates to about 125,000 shares per day or higher. Novice traders may elect to start with more heavily traded stocks to avoid problems with order fills and excessive slippage. For instance, stocks in the 70 to 99 percentile trade a minimum of about 500,000 shares per day. Volume bar's volume can be plotted as a histogram, a bar graph, that provides a visual representation of each trading period's volume. The histogram allows a trader to quickly analyze the pattern or trend of volume. The volume bars are colored red or green, which corresponds to the current time period's closing price. A red volume bar indicates a lower close than the prior trading period, and a green bar indicates a higher close. Figure 6.1 shows the volume bars plotted in the panel below the chart window. Analyzing volume patterns and trends. The amount of volume that transpires during one or more trading periods can tell a story about the force behind the price movement. Consider the following examples. If heavy volume accompanies the formation of a bullish candlestick pattern, such as a hammer or a bullish engulfing pattern, it helps confirm that the stock may be putting in a bottom. An upside breakout after a period of consolidation is usually accompanied by heavy volume. In fact, the breakout is suspect if not, and may be a false breakout. Volume attracts more buyers and is needed to propel the stock higher. Heavy volume may also accompany a downside break. However, it is not as significant because the market can continue to fall under its own weight. After an upward move, if price pulls back or consolidates on diminishing volume, it is usually an indication that short-term traders are taking profits after a directional move, rather than a large number of market participants exiting the stock. Another upside move often follows in such cases. These are just a few of the many instances where utilizing volume can provide insight into the psychology of traders. Incorporating volume in the examination of price movement can dramatically improve your stock selection and chart analysis skills. The preceding examples are instances where fairly short-term events are analyzed. It is important to distinguish between analyzing a short-term volume pattern and a longer-term volume pattern or trend. If you are examining the volume pattern over the past several trading periods, volume can be analyzed from one bar to the next, providing a short-term picture. For instance, if after an upward move, price pulls back on diminishing volume, in such a case you are looking at the price-volume relationship from one bar to the next as price pulls back. By my definition, diminishing volume occurs when most of the volume bars during the period being analyzed either drop below the moving average of volume or decline in a downward stepping pattern. See Figure 6.2 left. There may also be times when you wish to evaluate the volume pattern over a longer period of time. For example, you may need to gauge the strength of the longer trend or analyze the price-volume relationship of a large chart pattern. In cases where the bigger picture of volume is to be evaluated, look beyond the past few volume bars bars and instead look at the volume peaks. See Figure 6.2 right. Short-term analysis Figure 6.3 shows a daily chart of Calgon Carbon Corp. (CCC). Price was in an uptrend for several weeks during May to June 2007. The dotted lines correspond to the volume patterns during pullbacks within the trend. Each time price pulled back for a few days, volume declined with it. After a directional move, when price pulls back or consolidates accompanied by diminishing volume, it may offer traders an opportunity to get aboard a trending stock. Rather than chasing the stock as it is rallying or declining in a downtrend, the trader can use the interruption of the trend to enter at a point where an initial protective stop can be placed closer to the entry price. Longer-term analysis. When analyzed in conjunction with price action, volume can help us gauge the strength or weakness of a trend. Table 6.1 summarizes the general price-volume relationships that can be gleaned from intermediate and long-term trends. The emphasis here is on the trend of price and volume. The focus should be on the peaks, with less regard for each individual bar between the peaks. Figure 6.4 shows a daily chart of Riverbed Technologies Inc. (RVBD). During May to July 2007, price was in an uptrend. Notice that volume was heavy during the rallies that occurred early in the trend. As the trend matured, even though price was still forming higher peaks, the level of market participation had diminished, as evidenced by the volume pattern, declining dotted line. Although this type of price-volume pattern does not guarantee that the trend will change direction, it does indicate a divergence between price and volume, which should elicit caution among traders who hold long positions. On July 24th, price closed below a strong uptrend line, accompanied by heavy volume, which sent a stronger message that the trend direction may be changing. If you choose to expand your study of Western technical analysis, you'll inevitably be introduced to many Western continuation and reversal patterns. There are some small Western bar patterns, such as key reversals, and the inside and outside days referenced in Chapter 3. Flags and pennants also form in a short amount of time. Many of the Western patterns, though, are larger patterns that form over a period of several weeks or months. It is helpful to study the trend of volume as those large patterns form. For instance, a head and shoulders is a fairly reliable top reversal pattern. An ideal head and shoulders has the following volume pattern. Volume is strong as the left shoulder is formed. Volume is usually still strong as the head is formed. Volume declines noticeably as price pushes up to form the peak of the right shoulder. Technical analysis is a broad field of study, one area of which includes Western chart patterns, such as head and shoulders, triangles, and wedges, just to name a few. Many technical analysis books touch on this topic, but none that I have found delve into this area as thoroughly as Thomas Bulkowski does in his books. His latest book, Getting Started in Chart Patterns, John Wiley & Sons, 2006, is an excellent resource for those who wish to add an understanding of chart patterns to their knowledge base. Example: Figure 6.5 shows a head and shoulders top on the daily chart of Continental Airlines (CL). Volume was above average as a peak formed the left shoulder. This pattern actually had a double left shoulder. Price pulled back and then rallied again on above average volume to form the head. As price rose up to form the right shoulder, volume remained below average. There was not enough momentum to push price to a new high. Volatility. High volatility means that a stock's price can change dramatically over a short period of time in either direction. Low volatility means that a stock's price does not fluctuate dramatically. Volatility does not just apply to stock prices, but to other trading instruments and markets as well. Volatility is not static. It may be highly variable over time. There is typically an ebb and flow that can be seen on a chart. Periods of low volatility are often followed by periods of high volatility, and vice versa. Traders must learn to recognize when volatility moves to one extreme or the other. Great trading opportunities can be found by implementing adequate focus on volatility. Example: when price makes a directional move, the Bollinger Bands will diverge, expand, indicating a period of higher volatility. When price pulls back or moves sideways, the bands will converge, contract. If price moves sideways long enough, the bands will constrict around price, sometimes very tightly. This is referred to as a Bollinger Squeeze. This contraction-expansion phenomenon can be seen on the daily chart of Immersion Corp. (IMMR), shown in Figure 6.6. The term volatility may conjure up negative thoughts for those who do not understand or respect its role. A certain amount of volatility is necessary in order for stocks and markets to survive. And yet too much volatility can be frustrating and treacherous for traders, especially for those who do not yet have a lot of experience trading a volatile stock or market, as is the case with most trading-related concepts. It is usually not so much the volatility itself that is dangerous or risky, but rather the trader. Measures of volatility. There are various methods of measuring volatility. One measure is standard deviation, which measures the dispersion of data from the mean. In other words, it compares a stock's current volatility to its average. Bollinger Bands are constructed using standard deviation. Average. Beta is another commonly used measure, which compares a stock's volatility to that of the market. The S&P 500 Large Cap Index is commonly used as a market benchmark. After you have developed a strong foundation in charting, you may wish to expand your study of beta and standard deviation, or other measures of volatility, in order to further your understanding of this important concept. For now, though, consider using the logarithmic scale as a quick and easy method of gauging a stock's volatility. Logarithmic scale prices are displayed on the vertical axis, y-axis, on a chart. In most charting programs, horizontal division lines called grid lines are displayed in the chart window. They line up with the price scale. See Figure 6.7. There are two commonly used methods of scaling, arithmetic and logarithmic. The arithmetic scale displays the price change from one horizontal division line to the next in equal increments, points. The logarithmic scale displays the price change as a percentage. The scaling method you choose is up to you. Many seasoned traders use logarithmic for charting stocks, which is also my preference. When the logarithmic scale is selected, the percentage change between each grid line should be displayed in the chart window of your charting program, for example, below the price column, as shown in Figure 6.7. That percentage indicates that if price moves up or down one grid line, it is a move of approximately X% for that stock, with X being the percentage indicated, for instance, 1.29%. The percentage shown is not static. It indicates the current volatility. That percentage can change over time as volatility increases or decreases. The percentage between the grid lines can provide a gauge of a stock's current volatility. It can also be used to compare the stock's volatility to other stocks. Generally speaking, the higher the percentage displayed, the higher the current volatility of the stock, and vice versa. Looks can be deceiving. What may appear visually to be about the same distance move on the chart of two different stocks can actually be significantly different from a percentage standpoint. If you have ever been shocked by the change in your unrealized profit or loss on a trade after what appeared to be a small move on the chart, it was a volatile stock, or at least a volatile period for that stock. Example: Figure 6.8 shows a daily chart of Western Digital Corp. (WDC). From April through mid-July 2007, the stock gained about 40% during that time. The daily chart of Hoku Scientific (HOQ) in Figure 6.9 looks like it had a similar run-up. However, it gained almost 250% during that uptrend. Clearly, HOKU, at approximately 11% between grid lines, was a much more volatile stock than WDC, at approximately 3% between grid lines. As you continue your review of the remaining chapters, reference will be made several times to a stock's volatility, for example when determining whether the reward of a trade outweighs the risk, or when determining if a stock is better suited for swing trading or for a long-term position. End of Chapter 6. Chapter 7. Trend Analysis. The primary role of technical analysis is the study of trends. You may be familiar with some of the well-known axioms that have arisen over the decades regarding trends, such as, "The trend is your friend," and "Don't fight the trend." The phenomenon of trends is one of the major organizing principles of technical analysis. In order to become a skilled chartist, it is essential to learn how to identify and evaluate trends. Numerous trading strategies have been developed around the fact that markets tend to move in trends. Trend followers strive to identify a new trend as early as possible in its formation and ride that trend until it runs out of steam and changes direction. Therefore, much of technical analysis is devoted to the identification of trends, engaging their strength or weakness so traders can implement the appropriate trading strategies. A trend signifies the direction that the market is moving. In addition to the trend direction, traders also attempt to measure the duration, magnitude, and momentum of the trend. These concepts will be covered in this chapter. Trend direction. Markets move in trends. A stock or market may trend up or it may trend down. There may also be periods in which price moves sideways. While it might seem as if the direction of the trend should be quite obvious, that is not always the case, since trends do not develop in a linear fashion. The following discussion addresses some technical tools and methods to help determine the direction of a trend. Moving averages. The moving average is one of the oldest and most widely used technical indicators. Moving averages are trend-following indicators designed to catch major price moves. They are most effective when used in trending markets and fairly ineffective when price moves into a prolonged trading range. Moving averages are not precise timing indicators. While they do a good job of pointing out the direction direction of the trend. Moving averages lag price, so they will be late at calling the turning points when a trend changes direction. There are various ways to utilize moving averages. For the purposes of this discussion, we'll focus on the role of moving averages in helping determine the direction of the trend. In Chapter 9, you'll learn how they also play a role as support and resistance. Novice traders are encouraged to pursue additional study of moving averages, as well as other technical indicators that are beyond the scope of this book. A trend does not develop in a straight line. Price typically zigs and zags its way across the chart's landscape. Plotting a moving average over price helps to smooth out those fluctuations and distortions that are inherent in most trends. It provides a clearer picture of the primary direction of the trend. See Figure 7.1. In order to construct a simple moving average of price, the first step is to calculate the average. An average, or mean, of a set of values is determined by summing the values and dividing the result by the total number of values in the set. For stocks, the closing price is most often used in the calculation. To produce a moving average, the average is recalculated each new period. The newest bar's closing price is added to the calculation, and the oldest bar's closing price is dropped. The process is repeated, with each new bar resulting in a line that represents a moving average of price. Example: to compute a 20-period simple moving average, the closing prices of the last 20 bars are added together and divided by 20. When a new bar forms, the closing price of the 20th bar is dropped from the calculation, and the closing price of the new bar is added. Fortunately, modern charting programs do all the calculating for us. Traders need only to select the length for the moving average, and it will be plotted in the chart window. As shown in Figure 7.1, one or more moving averages may be plotted in the chart window. The 10 and 20 period are popular short-term moving averages. Longer moving averages will lag farther behind the current price, since there are more values included in their calculations. The 50 period is a popular intermediate-term moving average. Price often finds support at or near this moving average on a deep pullback in an uptrend, and vice versa in a downtrend. The 200 period is a long-term moving average that is watched closely by traders. Price often finds support or resistance at or near this moving average during a correction of a trend. Peaks and bottoms. As price moves up and down in the general direction of the trend, a series of peaks and bottoms is formed on the chart. A peak is formed after a price advance when price stops making higher highs and makes a lower high. A peak includes 3 bars, with the middle bar's high being higher than those of the 2 bars on either side of it. Figure 7.2. A bottom is formed after a price decline when price stops making lower lows and makes a higher low. It includes 3 bars, with the middle bar's low being lower than the bars on either side of it. Figure 7.3. Peaks and bottoms show where price turned, resulting in at least a temporary change in direction. A peak is often referred to as a swing high, and a bottom as a swing low. These events show us the turning points of price moves. Some of the swing points will be prominent, while others will be minor. The prominent formations will draw your attention to the direction of the trend, as shown in Figure 7.4. An uptrend is comprised of a series of higher swing highs and higher swing lows. Conversely, in a downtrend, lower swing highs and lower swing lows are evident. You'll see several examples of peaks and bottoms on the charts, shown in Figures 7.6 through 7.11. Candlesticks are excellent for short-term timing signals. After a directional price move, it is fairly common to see a candlestick reversal pattern form at the swing high or the swing low. Even if no reversal pattern forms, you'll often see other indications that the move is running out of steam, such as spinning tops or long shadows. Trend lines. A trend line is one of the simplest charting tools available, but don't let its simplicity take away from its value. Trend lines can be very helpful for determining the trend direction. Most charting programs provide a trend line drawing feature, allowing users to draw lines in the chart window. Classic trend lines are drawn on the chart connecting the turning points of the peaks or bottoms. The trend line should touch as close as possible to the actual turning point, the high of a peak bar or the low of a bottom bar. There will be times when the trend line will not quite touch the pivot, or will breach one or more bars. It is okay to clip one or more shadows if it means touching the trend line to more turning points. However, be careful about drawing the line through one or more real bodies, as doing so may result in an invalid trend line. There must be at least 2 turning points, touches, to draw a valid trend line. Ideally, there are 3 or more touches on the line. Trend lines with 3 or more touches are more significant than those with only 2. A common mistake traders make is attempting to draw a trend line across the highs or lows of individual price bars and neglecting to touch the line to 2 or more peaks or bottoms. The result is in an invalid trend line. Example: Figure 7.5 shows 2 trend lines. The lower trend line is valid because it connects the turning points of 3 rising bottoms. It was necessary and acceptable to clip the lower shadow of the second bottom in order to touch the third bottom. The steeper trend line is not valid because it touches rising lows, not rising bottoms. In an uptrend, the primary trend line is a rising support line drawn below and connecting the rising bottoms. See Figure 7.6. Once an uptrend starts to emerge, there must be 2 bottoms formed on the chart before a support trend line can be drawn. You may also be able to draw a parallel, rising resistance line above the rising peaks. It is common for price to rise in a channel. In a downtrend, the primary trend line is a declining resistance line drawn above and connecting the declining peaks. See Figure 7.7. You may also be able to draw a parallel, declining support trend line below the declining bottoms if the stock is descending in a channel. As the trend progresses, the primary trend line and the parallel channel line, if applicable, can be adjusted slightly and extended. Sometimes there will be more than one strong support or resistance trend line. In the example of Immucor Inc. Blood, shown in Figure 7.7, the downtrend accelerated in June 2007, resulting in a sharper angle of the declining peaks. Both resistance lines shown are valid. The tighter line is more indicative of the most recent price action and will be broken more quickly if the trend changes direction. Uptrend, bullish. Now let's combine the 3 methods mentioned previously for determining trend direction: moving averages, peaks and bottoms, and trend lines. The daily chart of Shaw Group Inc. (SGR) in Figure 7.8 illustrates a stock in an uptrend, which can be identified by the following criteria. It consists primarily of rising peaks and rising bottoms. Price remains above the 20-period simple moving average throughout most of the uptrend. A rising support trend line can be drawn below the prominent rising bottoms. In an uptrend, the magnitude of the upward swings is usually more than that of the pullbacks. The upswings typically consist of predominantly bullish candles. Therefore, once an uptrend has been established, it is usually best to trade in the direction of the trend, which means trading primarily long positions. In this type of environment, look for opportunities to buy on pullbacks, dips, or corrections in the trend. Downtrend, bearish. The daily chart of Retail Ventures Inc. (RVI) in Figure 7.9 shows a stock in a downtrend, which can be identified by the following criteria. It consists primarily of declining peaks and declining bottoms. Price remains below the 20-period simple moving average throughout most of the downtrend. A declining resistance trend line can be drawn above the prominent declining peaks. Once a downtrend has been established, it is usually best to trade in the direction of the trend, which means trading primarily on the short side. In this type of environment, look for opportunities to sell the rallies. Many novice traders get burned attempting to nail the bottom of a downtrend. They take long positions when they see a single bottom form in the downtrend, thinking it will be the one that finally reverses the trend. Often, it does not, and the result is a losing trade. Counter-trend trading is a practice best left to experienced traders. Example, the daily chart of Investools Inc. (SWIM) in Figure 7.10 shows how several single bottoms that formed in May to June 2007, identified by the short horizontal lines, were unsuccessful at reversing the downtrend. Finally, in July, a double bottom formed, dotted line, setting up a stronger reversal pattern. Sideways, no trend. When a stock moves sideways, it is a condition referred to as consolidation. The daily chart of Dry Ships (DRYS) in Figure 7.11 illustrates a stock that is consolidating, which can be identified by the following criteria. Price is confined within a trading range. There is no clear direction indicated by the peaks and bottoms. The 20-period simple moving average flattens out and may whipsaw. Price may cross above and below the moving average several times. The sideways price action can often be trapped between support and resistance trend lines. The trend lines may be parallel, as shown in Figure 7.11, or they may converge in the form of a triangle. Refer to Figure 7.13. Trend duration. There are 3 classifications of trend duration that have been widely accepted in Western technical analysis: long, intermediate, and short term. Traders should understand the definition of these trends and be able to identify them on a chart. Most of the examples shown in the following discussion represent an uptrending market. However, these technical events also occur in downtrending markets. Long-term trend. The long-term trend may also be referred to as the major or primary trend. Some sources state that a long-term trend is one that is in effect for at least a year. However, many traders, myself included, consider a trend of 6 to 8 months or longer to fall under the category of long-term. A long-term trend may be strung together by a series of shorter, intermediate-term trends. Price may move in the direction of the long-term trend for several weeks or months at a time, followed by an interruption of the trend that may also last for weeks or months. Those interruptions may be in the form of consolidation, sideways movement, or a correction in which price moves against the long-term trend. Example: Figure 7.12 shows a daily chart of O2 Micro International Limited, OIIM. The chart is compressed so that over a year of price data can be observed. It is clear that the stock is in a long-term uptrend. Price consolidated for about 4 months, from December 2006 through early April 2007. Price swung back and forth, forming the ceiling, resistance, and floor, support, of a trading range. Parallel, horizontal trend lines can be drawn to define the consolidation area. The 20-period simple moving average, SMA, flattened out during those months. Price broke out from the trading range on April 5th, resuming the long-term uptrend. The stock consolidated again from May through June. That consolidation was tighter than the prior consolidation. The 20-period SMA flattened out again until price broke out above the ceiling of the trading range on June 29th, once again resuming the long-term uptrend. In some cases, the consolidation takes the form of a triangle. Instead of parallel lines, converging support and resistance trend lines can be drawn to define the price action. Example: Figure 7.13 shows a daily chart of Honeywell International, HON. A long-term uptrend was interrupted for several weeks during March to April 2007. Price consolidated in the form of a symmetrical triangle, swinging back and forth for weeks and making no headway in the direction of the long-term trend. The 20-period SMA flattened out as price coiled into the apex of the triangle. Finally, price broke out from the triangle in mid-April 2007 and accelerated with a continuation gap on April 20th. Gaps are discussed in Chapter 8. The trend will not always resume after a period of consolidation. In some cases, what appears to be consolidation, when it forms at the right edge of the chart, will turn out to be topping, uptrend, or bottoming, downtrend, action that precedes a trend reversal. If a stock in an uptrend closes below the floor of a trading range rather than breaking out above it, the trend may be changing direction, and vice versa in a downtrend. In addition to periods of consolidation, as a long-term trend develops, there may also be times when price turns back against the trend, correcting a portion of the prior move. That correction may also be referred to as a retracement. Price retracements of 1/3 to 1/2 of the prior trend are common. A retracement of 2/3 of the prior trend may also be seen. If price corrects beyond 2/3 of the prior trend, it is considered to be a trend reversal, and the prior trend is unlikely to resume. The use of Fibonacci retracement levels has become increasingly popular since the advent of mainstream charting programs. Fibonacci refers to a sequence of numbers discovered by Leonardo Fibonacci, a 13th-century mathematician. Common Fibonacci retracement levels are 38.2%, 50%, and 61.8% of the prior trend. The 38.2% number is often rounded to 38% and corresponds fairly closely to the 1/3 retracement discussed previously. 61.8% is often rounded to 62% and corresponds closely to the 2/3 retracement. Example: Figure 7.14 shows a daily chart of Trinity Industries Inc. (TRN). After advancing for a few months, price retraced part of the prior uptrend, stopping at the 61.8% Fibonacci level. The uptrend resumed for several more weeks until late February 2007. Price corrected again before resuming the long-term uptrend. The long-term trend resumes after interruptions of the trend until it finally tops out, uptrend, or bottoms out, downtrend, and reverses direction. Always assume that the prevailing trend is in force until there is clear evidence to the contrary. Intermediate-term trend. An intermediate-term trend may also be called the secondary trend. It typically lasts from several weeks to several months. An intermediate-term trend is usually strung together by a series of shorter-term price swings that are separated by brief pauses, pullbacks, or periods of minor consolidation. Recall from discussion in Chapters 3 and 4 that the candlestick line tells a story of investor psychology. When you look at a candlestick line on the daily chart after the session has ended, you see the end result of the intraday battle between the bulls and bears. But if you wish to see the precise details of how that battle unfolded throughout the trading session, you need to shift down to an intraday time frame to see more price data. Take that same concept and apply it to trends. The long-term trend gives a big picture view of price action, but if you wish to see how that trend is developing, you'll need to analyze the smaller trends within the larger trend. There will be times when you'll observe a smooth long-term trend that only has minor interruptions, but that will be more the exception than the rule. More often, when you take a closer look, you'll see that the long-term trend zigs and zags its way up or down. If you analyze a typical long-term trend, you'll usually find that it is really several intermediate-term trends and periods of consolidation strung together. An intermediate-term trend can move in the direction of the long-term trend, or it can move against it. Look again at figure 7.14. The upward moves each lasted for several weeks. Intermediate-term uptrends, separated by corrections that also lasted for several weeks. Intermediate-term downtrends. Short-term trend. If you take the analysis a level lower, you'll find that there are yet shorter trends. A short-term trend may also be called a minor trend or a price swing. It typically lasts from a few days to a couple of weeks, but not usually more than about 3 weeks. There may be several such swings within a larger up or down trend. The short-term trend may move in the direction of the larger trend or against the trend, counter-trend. Example, figure 7.15 provides a closer look at one of the intermediate-term uptrends that formed on the Trinity Industries Inc. (TRN) chart, October to November 2006. A closer look at that uptrend shows that it is actually comprised of several short upward and downward price swings. Pay attention to the major market averages. Traders should not only analyze the charts of the individual stocks they trade, but they should be aware of the long, intermediate, and short-term trends of the major market averages. The tone of the broad market can have a strong impact on individual stocks. In the United States, the 3 best-known averages include the Dow Jones Industrial Average, the S&P 500 Index, and the NASDAQ Composite Index. While the direction of short and intermediate-term trends of the averages can be influenced by rumor, news, and the sentiment of market participants, the long-term trend of the market is driven primarily by fundamental factors. The major trend reflects the condition of the U.S. economy and may also be impacted by global markets. A long-term uptrend that occurs on an index chart is referred to as bull market, and a long-term downtrend is called a bear market. As of this writing, the broad market was still in a long-term uptrend. See figure 7.16. During July-August 2007, however, the major averages experienced a bull market correction. See figure 7.17. Of about 10%. Many individual stocks declined much more. Multiple timeframes. Whether evaluating the charts of individual stocks or market averages, take advantage of different timeframes to analyze trends. The long-term trend is usually quite obvious on a weekly or monthly chart. The higher timeframe provides a bigger picture view and eliminates much of the noise of the lower timeframes. When analyzing the intermediate and short-term trends, you'll want to see more detail, so use the daily chart. At times, you may even wish to consult the hourly chart to get a good feel for the short-term trend. Example, figure 7.16 shows a monthly chart of the S&P 500 Large Cap Index as of August 2007. You can see the historical bull market that ended in 2000, followed by the bear market of 2000 to 2002. Note that it took only 2 years to wipe out about 4 years of gains during that bear market, and it took the current bull market of almost 5 years to return to the prior bull market's high. In the markets, it usually takes longer to build up than it does to tear down. Figure 7.17 shows a daily chart of the S&P 500 index. The intermediate-term trend on the S&P 500 chart is down, and the short-term trend is up. The current short-term uptrend actually began intraday on August 16th, as evidenced by the long tail of the hammer. At the time the low was made, during that session, the candle was very bearish. The long tail shows us that there was a dramatic turnaround intraday as the bulls took control from the bears. It was a very volatile trading session. Probability and reversion to the mean. Don't worry, you won't have to attend a statistics class in order to learn how to trade successfully, although it sure wouldn't hurt. It is important, though, that traders understand some basics about averages and probability, because it can have a direct and potentially dramatic impact on their trading. Reversion to the mean. As a general rule, price does not deviate far from the average, or mean, and when it does, it becomes vulnerable to a change in direction. When price moves away from the average, it has a tendency to move back toward it, which is referred to as reverting to the mean. I pay attention to the proximity of price to the 20-period moving average. When price moves too far away from that strong moving average, I refer to it as catching air. Granted, That is not an impressive technical description, but it seems effective at getting the point across to traders who are learning about price movement. When price has moved too far from the average, the stock may be overextended. That condition can be alleviated either by price pulling back toward the average, figure 7.18 left, or by a period of sideways movement that allows the average to catch up, figure 7.18 right. In an uptrend, after price swings up, it is often followed by a decline back toward the average, called a pullback or a dip. Price may also pull back upward after a swing down in a downtrend. Pullbacks are quite common within a trend. They are primarily the result of traders taking profits on short-term price moves. Traders exiting their positions cause the minor retracements, which are often followed by another swing in the direction of the longer trend. When price moves sideways instead of pulling back, allowing the moving average to catch up, I refer to it as minor consolidation or basing action. The Japanese refer to this type of basing action as a box range. Basing action is a period of tight sideways movement after a directional price move, not to be confused with base building after a long downtrend that you'll see referenced in some technical analysis texts. A tight base may last from a few days to a few weeks. It is a less significant event than a prolonged period of consolidation that interrupts a long trend, such as a horizontal trading range or triangle shown previously. In a strongly trending environment, basing action is often followed by a resumption of the prior trend. The difference between a pullback and basing action is that a pullback turns against the trend, a countertrend move, whereas a base is a sideways move, refer to figure 7.19. Both of these setups have the effect of allowing the trend to rest up for another move. Such interruptions are healthy for a trend's development. Without them, price would move too quickly to extreme, unsustainable levels. The fact that the stock is able to consolidate the gains and then move again in the direction of the longer trend is a testament to the trend's strength. Note: if a pullback or a period of basing action is preceded by a sharp upward move or a sharp decline in a downtrend, it may be referred to as a pennant or a flag. When price has moved away from the average, it becomes vulnerable to profit taking by swing traders. So be alert for candlestick reversal patterns. Reversal patterns often give short-term reversal signals at or near the end of price swings. Figure 7.20 shows a daily chart of CalDive International Inc. (DVR). Price was in an uptrend from April through July 2007. The following discussion corresponds to numbers 1 through 8 on the chart. 1. A strong rally moved price far above the 20-period simple moving average (SMA). Notice how much air there was between price and the moving average. That was not just air, it was Air Jordan. On April 16th, a bearish dark cloud cover pattern formed. 1. 2. Price pulled back to the 20-period moving average and consolidated for several weeks. It is not unusual for a stock to consolidate the gains after a strong move. 3. Price rose up again away from the moving average. On June 5th, a dragonfly doji formed, followed by a near gravestone doji. 3. The following session. 4. Price pulled back to the moving average, offering buyers another entry opportunity. The next swing up began with a bullish engulfing pattern. 4. On June 13th. 5. Price lifted up from the average and gapped up on June 15th. 2 spinning tops followed, signaling a loss of momentum of the move. On June 20th, a bearish engulfing pattern formed. 5. Starting another pullback toward the moving average. 6. Price stopped declining at the 20-period SMA and consolidated there for a few days. 7. Price caught air again, ending with another dark cloud cover pattern. 7. On July 9th. 8. Price pulled back below the moving average. Booms again. On July 18th, a bullish engulfing pattern formed. 8. If a candlestick reversal signal calls the end of a price swing, and then price resumes the longer trend after pulling back or consolidating, it does not mean that the candlestick pattern failed. The presence of a reversal pattern does not imply that an entire intermediate or long-term trend will reverse. When price pulls back or consolidates after an upward move, it does change direction for a period of time, either from up to down or from up to sideways, respectively. Candlestick reversal signals serve as warnings that a change in price direction may occur. They do not tell us how significant the change will be or how long it will last. Reversion to the mean does not only occur in an uptrend. Watch for the same phenomenon in a downtrend. There will always be sellers covering short positions and bottom fishers looking for buying opportunities, whose trading actions will drive price back toward the mean. Figure 7.21 shows DVR again, but this time a few months later. The stock topped out in July 2007, forming a bearish Western head and shoulders top. 3. Price closed below the neckline, dotted line, of the head and shoulders pattern on July 26th, confirming the bearish pattern. Price curled back up a few days later and tested the neckline as resistance. It is very common for prior support to be tested as resistance after a breakdown, and vice versa after an upside breakout. The price action that occurred during the subsequent decline corresponds to numbers 1 through 4 on the chart. 1. Price declined for a couple of weeks, moving far away from the 20-period SMA. The decline ended with a gap down and intraday sell-off on August 6th. By the close of that session, the stock had recovered much of the intraday decline, as evidenced by the long tail, and formed a bullish hammer 1 on the daily chart. During the following session, a bullish engulfing pattern formed around the hammer's real body, and the prior session's gap was filled. Price closed well off its high on the engulfing day, leaving a long upper shadow and evidence that there were still sellers around. 2. The next day, price traded up to near the 20-period SMA2 intraday. Here you see the reversion to the mean. The stock then closed well off its high, leaving another long upper shadow. 3. Price declined again and tested the August low at 1, setting up the potential for a Western bullish double bottom pattern. A bullish hammer 3 formed on August 16th, creating a smaller candlestick pattern within the larger double bottom. I call this a pattern inside a pattern and interpret it as strengthening the larger setup. 4. Price moved back up to the 20-period SMA. The phenomenon of reversion to the mean offers traders opportunities to enter positions at lower risk areas than when price has moved away from the average, where it is vulnerable to a setback. Reward and risk will be addressed later in this book. The importance of probability. Trading successfully is not a matter of chance. It is a result of trading in a manner that puts the odds of winning on your side. For example, when price moves too far away from the average, it is more likely to revert to the average than to continue moving farther away from it. That is not to say that when price moves away from the average and moves back toward it, a long trend is likely to reverse. Remember that price tends to swing back and forth while still moving in the general direction of the trend. See figure 7.20. Since the probability is good that price will revert to the mean, that factor should influence the way traders select and manage their trades, especially swing traders. If a swing trader holds a long position in a stock and does not wish to hold it through a pullback, once price catches air, it may be time to exit or start scaling out of the position, or at least be very watchful for a warning, such as a candlestick reversal signal. If a stock that he does not yet hold a position in, but would be interested in purchasing, has moved far away from the average, he can watch for a dip back toward the average for a lower risk entry opportunity. If an entry is taken while the stock is far away from the average, chances are good that the trader is setting himself up to hold through a pullback or sideways move. Even traders who hold long-term positions should evaluate each stock individually. An investor may plan on holding through pullbacks as the trend develops. However, looks can be deceiving. Don't forget to consider the stock's current volatility. What may appear to be a small move on the chart may actually be a significant percentage move. Example, figure 7.22 shows a daily chart of Echelon Corp. Elon. Price pulled back to the 20-period SMA in late July 2007. Price consolidated for a few days, followed by a strong swing up. At that point, price had moved away from the average, leaving a pocket of air below, and the stochastic oscillator provided an overbought reading, indicating the move was overextended. The stochastic oscillator is discussed later in this chapter. Price then turned down for several days, finally stopping at the 50-period SMA. Recall that you can quickly look at the logarithmic scale to get a gauge of the stock's current volatility. To find out exactly how far this stock fell, calculate the distance from the high of the upswing, $32.49, to the low of the downswing, $19.92. The difference was $12.57. or a decline of approximately 39% from the swing high to the swing low. Notice that a long lower shadow formed the swing low, indicating that bulls were willing to step into long positions at the 50-period moving average. The example in figure 7.22 was chosen in order to point out the following. Short-term traders who held long positions during the swing up would have no desire to watch all of their gains disappear. Even long-term traders would have to question whether they would wish to watch a stock decline so far. If a protective stop were utilized, recommended, that did not exceed the trader's maximum risk tolerance, for example, 10% for a swing trader and 15% for an investor, the stop would not have held up through the decline. stock. Once price caught air, the probability of a pullback was high. A trader who chased this stock and entered a long position near the swing high watched the trade immediately turn negative and had a very painful experience due to a poorly timed entry. Be careful not to fall into the wishful thinking trap. When looking back from the right edge of the chart at a stock that trended for a long period of time, you may think you could have just held on through all the pullbacks and periods of consolidation. Looking at a past chart of a stock in which you held no position is a quite different situation than monitoring a live trade in which real profits are at stake. In some cases, a trader can hold on for much of the trend using a trailing stop. However, in many cases, a trader may get stopped out one or more times as the trend evolves. And if a stock is volatile, what might look like it was a minor pullback on the chart may have equated to a significant percentage decline. Although holding through a decline may not sound like a big deal, that's where experience, with real money invested, is needed in order to determine psychologically what you can handle. Short-term traders typically do not plan to hold through pullbacks. If a short-term trader finds himself holding through a lot of pullbacks, it may be an indication of poor trade selection and management. Lack of discipline will lead to failure in this business. Plan your trades in advance and know what justifies an entry, where to exit with a profit if the trade goes as expected, and where to exit with a protective stop in case it goes against you. Beware of chasing overextended stocks. A common mistake made by inexperienced traders is to chase after a stock entering a position when price has become overextended. Unfortunately, new traders often are not aware of the concept of reversion to the mean. Even those who are aware may choose to take the gamble, hoping that price will continue to move unabated. They let their emotions get the best of them. Emotional decisions typically lead to sloppy trade execution and losses that could have been avoided. Experienced traders do not generally buy the swing high or sell the swing low and then hold on trying to ride out a pullback. More often, it is the experienced traders who are gladly selling their shares near the swing highs to the novice traders who shouldn't be buying at such overextended levels. The traders who buy the swing highs are sometimes called the greater fools, because there is no greater fool willing to pay higher prices, so they are left holding the bag, so to speak, as the stock turns against them. The experienced traders are also the ones who are waiting to take the shares off the hands of the novices who bail out, because the pain of entering too high and then having to hold through the subsequent pullback becomes too much for them. In other words, experienced traders look to enter on weakness, pullbacks or consolidation, and exit into strength as price gets overextended. Momentum of the trend. In addition to determining the direction and duration of a trend, there are also methods of measuring its momentum. In his book Technical Analysis of the Financial Markets, New York Institute of Finance, 1999, page 228, John Murphy defines momentum as follows. Momentum measures the velocity of price changes as opposed to the actual price levels themselves. Oscillators are a group of indicators that measure the momentum of price, the rate of its ascent or descent. Price often loses momentum before it actually changes direction. Thus, oscillators may act as leading indicators of price. While there are many different oscillators with different methods used to calculate them, their interpretation doesn't vary much. Be careful using too many oscillators, because they basically measure the same thing. There are usually at least a few oscillators to choose from in most charting programs. Stochastics and Wilder's Relative Strength Index, RSI, are among the best known. Unlike moving averages, which tend to whipsaw when price moves sideways, oscillators are effective in a non-trending environment. They can help catch the turning points when price swings back and forth across a trading range. The oscillator's fluctuations tend to correspond to the peaks and troughs in price. Oscillators are not limited to non-trending environments. They can also be helpful in a trending market. Oscillators have several uses in this regard. Overextended conditions. When price is rising and an oscillator reaches an extreme high level, it sends a signal that price may be overextended to the upside or overbought. When an oscillator reaches an extreme low level, it indicates that price may be overextended to the downside or oversold. Overbought and oversold readings warn that price is vulnerable to at least a short-term change in direction. Divergence analysis. When higher peaks are forming in an uptrending market, but the peaks of the oscillator are declining, a negative, bearish, divergence exists. In a downtrending market, if price is forming declining bottoms, but the oscillator bottoms are rising, it signals a positive, bullish, divergence. A divergence between price and the oscillator is a sign that the trend may be weakening. Relationship to the midpoint. Many oscillators have a midpoint. For some oscillators, that point is 0. Others that move along a scale of 0 and 100 have midpoints of 50. When price turns up after a downtrend, the oscillator will cross the midpoint and remain above it for most of the uptrend, and vice versa when price reverses from up to down. Traders may use the crossing of the midpoint as a buy or sell signal. For now, we'll focus on using an oscillator, namely stochastics, to help determine when price may be overextended. Stochastic oscillator. The stochastic oscillator is a very popular momentum indicator developed by George Lane. It is based on the premise that when price is trending up, the closing prices will tend to be near the high of the price range. In a downtrend, the closing prices will be nearer the low of the price range. The indicator includes two lines, the faster %K line and the slower %D line. The %K line is the stochastic. The %D line is a moving average of %K, which smooths the stochastic and acts as a signal line. The result is two lines that oscillate between fixed lower and upper boundaries of 0 and 100%, respectively. Figure 7.23. The calculation compares the most recent closing price, on a percentage basis, to the total range of price over a designated period of time. Time periods must be chosen for the stochastic and the moving average. Example: two commonly used lengths are 14 periods for the stochastic, with a 5-period moving average, the 5th of May 14, and 12 periods with a 3-period moving average, the 3rd of March 12. As is usually the case with technical indicators, if you opt for speed, you give up some accuracy, and vice versa. A stochastic length of 14 will produce slightly slower signals, but they may be more accurate. A length of 12 will produce faster signals, although there may be more false signals. Within the boundaries of 0 and 100 lie the overbought line, 80, and the oversold line, 20. A reading of over 80 is considered to be high. It indicates that the current closing price is near the top of the designated range. Conversely, a reading of below 20 is considered to be low. The current closing price is near the low end of the designated range. Overbought and oversold conditions. The stochastic oscillator can be used to alert traders of short-term price extremes. At times, price moves for too long or too far too quickly in one direction. The result is an overbought, uptrend, or oversold, downtrend conditions. These conditions are generally short-term in nature and can be alleviated by a pullback, correction, or a period of consolidation. In a strong trending market, confident bulls, uptrend, or bears, downtrend, will often step back into trades once the short-term overextended condition has been alleviated. There will certainly be cases when the trend will reverse after such conditions arise. However, it takes a consensus by many market participants to reverse a strong trend. Therefore, overbought and oversold signals should generally be interpreted to be short-term in nature unless there is additional evidence that a trend reversal is in the making. If a bearish candlestick reversal pattern forms while stochastic is in overbought territory, or if a bullish reversal pattern forms while stochastic is in oversold territory, it strengthens the candlestick signal. In these cases, a candlestick pattern forms when the stock is already vulnerable to a change in the direction of price. Example: Figure 7.24 shows a daily chart of Advanced Micro Devices (AMD). In mid-July 2007, the price advance showed signs of trouble with the formation of 3 doji within 4 trading sessions. A strong bearish engulfing pattern formed on July 20th. Price had moved up away from the moving average, and the stochastic oscillator was in overbought territory, adding more evidence that a change in the direction of price was likely to occur. Enhanced candlestick signals. Now you know that when price moves far from the average, it tends to revert to the mean. In addition, when the stochastic oscillator signals overbought or oversold, price is vulnerable to a change in direction. These two scenarios will often occur in sync, but not always, so I don't recommend that you require that price be far from the average and the stochastic oscillator be at an extreme in order to justify acting on a candlestick signal. However, if either or both conditions are present, the odds are good that a change in the direction of price will occur. Example: Figure 7.25 shows a daily chart of DTS Inc. DTSI. Price made a strong swing up in early August 2007, ending with a bearish shooting star on August 8th. Follow the dotted line down from the shooting star to below the chart window, and you'll see that the stochastic oscillator, with a setting of the 5th of May 14, middle panel, did not provide an overbought reading. Even with a shorter setting of the 3rd of March 12, lower panel, the indicator did not move above the overbought line. However, notice how far the 2 long bullish candles that formed prior to the shooting star pushed price above the 20-period SMA. In this case, in spite of the absence of confirmation from the oscillator, a change in the direction of the short-term trend should be anticipated. Price consolidated for a period of time after the appearance of the shooting star. Example: Figure 7.26 shows a daily chart of Kohu Inc. (COHU). Price declined far below the 20-period SMA by early August 2007. On August 7th, the stock gapped down open but closed deeply into the prior bearish candle's real body, forming a bullish piercing pattern. In this example, not only was price far below the moving average, but the stochastic was in oversold territory. Price then rallied back up to the average. There will certainly be candlestick reversal signals that follow through when neither of the preceding conditions is present. The likelihood of a successful signal increases, though, if there is more evidence that price is overextended and vulnerable to a change in direction. End of Chapter 7. Chapter 8. Gaps. No instruction on charting would be complete without a discussion of gaps. It is important for traders to be able to identify gaps and understand their implications. For decades, gaps have been recognized in Western technical analysis. However, the identification and analysis of gaps did not originate in the West. The Japanese utilized gaps in their analysis long before they became known in the Western Hemisphere. In Japanese candlestick charting, price gaps are referred to as windows. In this chapter, you will be introduced to price gaps in a very common event called the morning gap. Since the term gap is so well known, for consistency, gap will be used throughout most of this discussion rather than the Japanese term windows. Price gaps. A price gap is also called a true gap because it leaves a void on the chart. The gap is still open by the end of the daily trading session, leaving empty space where no trading took place. Neither the real bodies nor shadows of the two consecutive bars that form the gap can overlap. In order for an upside gap to form, the low of the current bar must be above the high of the previous bar. Figure 8.1. The Japanese refer to an upside gap as a rising window. For a downside gap to occur, the high of the current bar must be below the low of the prior bar. Figure 8.2. The Japanese call a downside gap a falling window. Even if a gap is very small, it is still valid. And remember that looks can be deceiving. If the stock is volatile, what looks like a small gap may be bigger percentage-wise than you realize. Refer to the discussion on volatility in Chapter 6. Most price gaps are emotionally driven events that occur largely because of news that is released and disseminated between the close of one day's trading session and the open of the following session. The news need not be related directly to the stock in question. Stocks may be impacted by the news of other companies, sectors, industry groups, and global events. If there is no news and no significant demand that has built up for a stock, it should open at or near the prior session's close. However, if there is news or enough demand, the market maker will fill the pending market orders accordingly, resulting in the stocks gapping up or down at the open. Price gaps are most commonly seen on daily charts. Other than at the open, you won't often see true gaps, voids, on intraday charts. There are some exceptions, of course. For instance, if a stock is not very heavily traded, gaps may occur intraday. If news is released on a stock during trading hours, it may result in one or more price gaps intraday. If a stock's trading is halted temporarily, price may gap once the stock opens again for trading, or in a fast-moving market, gaps may occur. Otherwise, most of the gaps that you'll see on intraday charts are fairly small gaps between the real bodies. The real bodies or shadows overlap, so no void is visible on the chart. Gaps do occur frequently at the open. They are called morning gaps and are discussed in detail later in this chapter. True gaps are fairly rare on weekly charts, and even rarer on monthly charts. Each weekly bar includes 5 days of data, and each monthly bar includes about 20 days of data. Many gaps are filled during the week or month before the next bar begins. Types of price gaps. The Japanese refer to gaps simply as rising, bullish, or falling, bearish windows. Western technical analysis takes the definition of gaps further. Rather than identifying gaps based strictly on the direction of the gap, either upside or downside, they are also defined by the price action that precedes and follows the gap. There are several different types of gaps observed in Western technical analysis. An area gap occurs when price gaps either up or down within a trading range. An area gap may also be called a common gap or a pattern gap. Figure 8.3 shows 2 area gaps that formed while price was consolidating. These gaps have very little technical significance. They are usually filled quickly as price moves up and down between the boundaries of the trading range, the dotted lines in Figure 8.3. A breakaway gap is a technically significant gap. It often marks the beginning of a strong price move. An upside breakaway gap is a bullish signal that occurs when price gaps above and closes above resistance. It should be accompanied by heavy volume. A downside breakaway gap is a bearish signal that occurs when price gaps below and closes below support. A downside breakaway gap may be accompanied by heavy volume, but if it is not, it does not take away from the signal like the upside gap. It usually takes more force to propel price higher than for a stock to decline. A continuation gap occurs when a stock is trending and price leaps forward, accelerating the move. A continuation gap may also be called a runaway gap. This type of gap may occur in an uptrending market, bullish, or a downtrending market, bearish. It is said to mark the halfway point of a trend, which is why it is sometimes referred to as a measuring gap. A continuation gap is often filled weeks or months later during a correction or reversal of the trend. An exhaustion gap occurs after a sharp move or a long trend. This gap may follow one or more prior gaps, for example, a continuation gap. However, that will not always be the case. Sometimes an exhaustion gap is not preceded by other gaps. As its name implies, this type of gap represents a climax or exhaustion move. It is often a last blast of buying in an uptrend or capitulation in a downtrend, followed by a sharp reversal, or at least a shift to a period of consolidation. Exhaustion gaps are typically accompanied by heavy volume, and they are usually filled quickly. Example: Figure 8.4 shows a daily chart of Foster Wheeler Limited, FWLT. On April 3, 2007, price gapped up above the ceiling of a horizontal trading range, dotted line, completing a bullish breakaway gap. Several weeks later, on May 9th, price gapped again, forming a bullish continuation gap. Both the breakaway gap and the continuation gap were accompanied by heavy volume. Figure 8.5 shows a daily chart of Transocean Inc., RIG. After trending up for several months, price gapped up on July 23, 2007. The gap was accompanied by heavy volume. Price reversed direction immediately and filled the gap, making it clear that it was an exhaustion gap. When analyzing a gap at the right edge of the chart, you cannot always identify the type of gap at the time it forms. If price is consolidating in gaps but does not break out, it is fairly easy to identify it as an area gap. Likewise, the breakaway gap is obvious because it gaps away from consolidation. However, with a continuation or exhaustion gap, you won't know for sure at the time it forms which gap it will turn out to be. It takes at least one more bar, and sometimes several more, before it is evident whether it is a continuation or exhaustion gap. Keep this idea in mind when you develop the rules of your trading strategies and outline how you'll respond to a gap should one occur. Example: Figure 8.6 shows a daily chart of Canadian National Railway, CNI. After a steep run-up, price gapped up on July 18, 2007, accompanied by very heavy volume. Price consolidated within the long bullish candle for 3 days. On July 24th, price gapped down, forming a bearish island top, circled. By early August, price had retraced much of the prior uptrend. An island reversal pattern is formed when price gaps in the direction of the trend and then gaps in the opposite direction, leaving one or more bars with a void on both sides. In an uptrend, this price action is called a bearish island top. If it occurs in a downtrend, it is a bullish island bottom. When has a price gap been filled? The market does not like voids on a chart, so there is a strong tendency for gaps to be filled. Most gaps are eventually closed. Some gaps are filled quickly. For example, most area gaps and exhaustion gaps. Others may take weeks, months, or even years to close. A breakaway gap, or a gap that occurs at the beginning of a long trend, may not be filled for a long time. There are occasions, although they are infrequent, when a gap is never filled. After an upside gap forms on a chart, at some time in the future, price may fall back through that void. If price declines back to or near the bottom of the void, the gap has been closed. Figure 8.7. The reverse may occur with a downside gap. In Western technical analysis, this price action is referred to as filling or closing the gap. The Japanese would say, "The window has been closed." Price will not always fill the gap entirely. In some instances, much of the gap will be filled, but price changes direction again before filling the entire gap. If most of the void has been filled, traders generally consider the gap to be closed. Gaps as support or resistance. The phenomenon of support and resistance is a very important tenet of Western technical analysis. It is so essential that Chapter 9 is devoted to it. As you'll learn in that discussion, there are several types of support and resistance, including gaps. When an upside gap is filled, the bottom of the void should provide support. If price closes below the gap, support has been broken and the message turns bearish. Conversely, when a downside gap is filled, the top of the void should act as resistance. If price closes above the gap, resistance has been broken, which is a bullish sign. Interpreting price gaps. The Japanese refer to a gap as a continuation pattern. An upside gap is interpreted as bullish, and a downside gap is bearish. This is only a general concept though. Be careful about trying to employ a one-size-fits-all rule in technical analysis. Just because an upside gap is considered bullish does not mean price may not decline first or move sideways before resuming the uptrend, and vice versa for a downside gap. In addition, don't expect price to always move again in the direction of the gap. Sometimes price reverses direction, trades back through the gap, and just keeps going, resulting in a reversal rather than a continuation of the trend. The context in which the gap forms should be considered. Each price gap should be analyzed individually when determining how to respond to it. Following are some factors to consider. Size of the gap. Price action that preceded the gap. Did the stock gap out of consolidation? How far had price already moved prior to the gap? Is price overextended and vulnerable to a change in direction? Surrounding chart landscape. Is there resistance nearby that may cause an upward price move to stall or reverse? Or support below that may stop a downside move? Style of trading utilized. Is this a short-term trade or a longer-term trade that may be held for weeks or months? Trader's temperament. What is the trader's risk tolerance and risk and money management rules? Current volatility of the stock. Current environment of the broader market. The discussion that follows addresses these factors and is intended to provoke thought on how you might interpret and react to an upside gap. The same thought processes should be considered when analyzing a bearish gap, except that the gap is to the downside. Figure 8.8 shows a daily chart of Checkpoint Systems Inc., CKP. The upside gap that occurred on August 2, 2007 was a large gap driven by news. This gap encountered a strong resistance area at the June to July Western double top dotted line. After such a move, it is not unusual to see price turn immediately back down and at least partially fill the gap. Additionally, the major averages had sold off in late July, so the broad market environment was volatile. The stock reversed direction and filled the gap within the next few days. This example illustrates the importance of evaluating each gap individually. I certainly would not advocate entering a new long position on the gap-up day in a scenario like this one. The stock may move higher, however the probability is high in such a situation that price will decline, or at least move sideways, before it will break out to a new high. If instead of reversing at the double top resistance area, price had gapped over it and closed above it, the signal would have been a bullish one. Figure 8.9 shows a daily chart of Fremont General Corp. FMT. Regarding the style of trading, consider the following two scenarios. Trader A is a swing trader, which is a shorter-term style where positions are typically held from a few days to a couple of weeks. He entered a long position in FMT in early April 2007, near support provided by the March low. After price advanced for a few days, the gap-up open on April 16th was a big bonus. Trader A used the gap to exit the trade with a sizable gain. Trader B is an investor who typically holds positions longer term. She also entered a long position at the same area as Trader A, but she intends to hold the position for several weeks or even months. She may have no reaction to the gap other than to raise the protective stop to preserve much of the gains in the event price breaks down. Now consider the question of the stock's current volatility. The stock had already risen approximately 23% from the support area before it gapped up. Then on April 16th, the stock gapped open approximately 35% higher than the prior session's close. After such a strong move up, profit-taking by short-term traders may force the stock down and fill the gap. In the case of FMT, the distance from the open of the April 16th gap day back to the bottom of the void, the high of the bar prior to the gap day, was about 24%. The swing trader would not wish to hold through such a decline. And, in fact, Is the investor willing to allow the stock that much room to pull back? Even for longer-term trades, the volatility should be considered. Say that Trader B has a risk management rule, recommended, that she will not allow a long-term position to reverse more than 15% from the current price, or the stock will be exited. That is not to say that a stop should be placed an arbitrary 15% away from the current price, but rather it should be placed at a technical level not to exceed the maximum allowed reversal of 15%. In that case, Trader B's stop is likely to be triggered. If FMT pulls back and fills the gap, the distance to the bottom of the void is almost 10% further than Trader B's maximum stop level would allow. It need not be an all-or-nothing decision. The investor may elect to sell some shares on the gap and raise the stop on the remaining shares. As such, if price continues higher, she will still hold a partial position. However, less of the gains would be exposed to a potential pullback that may be enough to trigger the protective stop. In summary, an upside gap may ultimately turn out to be a bullish event. However, whether it is a gap, a candlestick signal, or some other technical event, it is prudent to look beyond just that particular event. Trading successfully means considering other factors that can impact your trades. The morning gap. A morning gap is also called an opening gap because it occurs at the open of a daily trading session. Morning gaps are very common on daily charts, much more so than true gaps. They occur due to order imbalances that are managed by market makers at the open. Morning gaps occur on stocks, but not on the charts of continuous 24-hour futures. All gaps actually start out as opening gaps. A true gap must open beyond the prior day's range, above the prior high for an upside gap, and below the prior low for a downside gap. By the close of market, that gap has not been filled, which leaves a void on the daily chart. A morning gap also gaps up or down at the open. However, it does not leave a void on the daily chart. The gap is closed during the trading session. Figure 8.10 shows the contrast between a true gap and a morning gap. A morning gap is defined by the opening and closing prices of two consecutive daily bars. In order to form an upside morning gap, price must open above the prior day's close. Figure 8.11. Price may even open above the prior day's high. Figure 8.12. But at a minimum, there must be a gap up between the two real bodies at the open. Some traders even refer to this gap as a body gap. For a downside morning gap, price must open below the prior day's close. Figure 8.13. Or its low. Figure 8.14. When has a morning gap been filled? A morning gap is filled when price reverses the opening direction intraday and trades back at least to the prior day's close. An upside morning gap is filled if any of the following is present on the chart by the close of market. The inverse is true for a morning gap down. The current day's low is the same, or very near the same, as the prior day's close. See Figure 8.11. The prior day's close is a natural support level, so it is not unusual to see price stop falling there. The current day's lower shadow pierces the prior day's real body. Not shown, but if the lower shadow in Figure 8.11 was longer, it would be an example. The current day's real body touches, protrudes into, or engulfs the prior day's real body. Figure 8.12. The fact that there is an overlap between the real bodies, or their shadows, by the end of the session means it cannot be a true gap. Variations of the morning gap. A variation of the morning gap occurs when price gaps up open above the prior bar's high, trades back to the prior bar's high or lower, but does not decline all the way back to the prior bar's close. Figure 8.15. This intraday price action closes the void on the daily chart that is created at the market open, but it does not close the entire intraday gap between the bodies. Another variation occurs when price gaps up open above the prior day's close and trades within that prior session's upper shadow. Price does not trade all the way back to the prior day's close, so again, the intraday gap between the real bodies is not completely filled. Figure 8.16. In this case, there is never an actual void on the daily chart because price does not open above the prior session's high. However, there is still a gap between the two bars' real bodies. The inverse of the above variations may also occur with a downside morning gap. Intraday view of a morning gap. Most opening gaps fill, or at least partially fill, within the trading session, leaving no void on the daily chart. They often fill early in the day, frequently within the first hour of trading. Example: using the Schlumberger Limited (SLB) chart from Figure 8.10 as an example, let's take a look at an intraday view of a morning gap. Figure 8.17 shows the daily price action on the left, which led up to the opening gap on July 23, 2007. On the right is a 5-minute chart showing the first 50 minutes after the open on July 23rd. The 5-minute chart demonstrates how price gapped up open but traded no higher. That is evident by the hanging man, with a shaven top that formed in the first 5 minutes of trading. If price had traded higher after the open, that 5-minute hanging man and the daily candlestick would have an upper shadow. The stock declined from the open and filled the morning gap within the first 20 minutes of the trading session. Although you will no longer see a void on the daily chart once the gap is filled, you can see how and when price rolled over and filled the gap on the 5-minute time frame. Essentially, it is an intraday exhaustion gap if it occurs after a directional move. Depending on how fast the opening gap is filled, you may not see the actual void on all intraday time frames. For instance, the SLB gap in Figure 8.17 filled quickly, so no void would appear on the 30 or 60-minute charts. However, it is still visible on very low time frames. There will be some cases in which the gap is filled so quickly that it isn't even visible on the 5-minute time frame after the first 5-minute bar has closed. Morning gaps and candlesticks. You may be thinking that the morning gap is an interesting and useful phenomenon, but what does it have to do with candlestick charting? Take a closer look at Figures 8.11 through 8.15. The morning gap up in Figure 8.11 occurred after a warning from a bearish upper shadow the prior session. Long shadows were discussed in Chapter 5. In Figure 8.12, observe that the morning gap became a bearish engulfing pattern that surrounded the small real body of a hanging man that formed the prior day. A downside morning gap in Figure 8.13 turned into a bullish engulfing pattern by the end of the session. Figure 8.14 became a bullish piercing pattern. All of these events occurred after a price advance or a decline, so there was a move to reverse. Not all morning gaps will turn into candlestick reversal patterns. However, you may be surprised at how many reversal patterns do evolve from or include a morning gap. Make sure to carefully study the criterion of the reversal patterns provided in Chapter 3, because several of them require an opening gap for a valid pattern. Example: both the dark cloud cover and the piercing patterns start with a morning gap, and the star patterns have a gap between the first and second real bodies in their formations. Most engulfing patterns also develop from a morning gap. Interpreting the morning gap. Since all gaps start as opening gaps, you won't know at the time price gaps open how the day will unfold. Will a void remain on the chart, a true gap? Or will the gap be closed, resulting in a morning gap? Remember, though, that morning gaps occur frequently, much more so than true gaps. Therefore, when a stock does gap open, it has a high likelihood of filling within the trading session, and often early in the trading day. Keep that in mind when determining how you'll react to opening gaps. The manner in which a trader chooses to react to an opening gap may vary from one situation to the next. Again, the following should be considered: the size of the gap, the price action that preceded the gap, the surrounding chart landscape, the style of trading utilized, the trader's risk tolerance and risk and money management rules, the current volatility of the stock, the current environment of the broader market. Since morning gaps are very common, traders who hold long-term positions may choose to ignore many opening gaps. Otherwise, they may exit a position prematurely. Even when holding longer term, though, situations may arise in which an opening gap should not be ignored. Always consider the context in which the gap formed. Swing traders are much less inclined to ignore an opening gap. Because of the short hold time, the way they manage gaps may make a significant difference in their profitability. The remainder of this chapter is devoted to discussion of how morning gaps can affect short-term positions and how swing traders may choose to respond to such events. The discussion and examples refer to trading long positions. However, the same concepts apply inversely for shorting. Even if most of your trades are longer term, you should review the remaining pages, as you may pick up some valuable information. The opening gap's role in swing trading. The opening gap is an important concept to understand and is a component of many day trading and swing trading techniques and strategies. Trading decisions should not be based on emotions. They should be based on logical conclusions. Knowing that most opening gaps will reverse direction intraday should be a consideration when swing traders define their short-term strategies. Location matters. Just as it matters where a candlestick reversal pattern forms on a chart, it must have a move to reverse. It matters where an opening gap occurs. It is important to consider the price action that preceded the gap. If a trader holds a long position in a stock that has just started to move up, an opening gap, especially a small one, may not be a significant event. However, if price has already moved a good distance away from the average, an upside opening gap may be much more meaningful. It may represent a signal to exit all, or at least part, of a swing position, particularly if price gaps open substantially beyond the prior trading session's close. Recall from Chapter 7 that price tends to revert to the mean. Thus, when price has moved away from the average on the daily chart, it becomes vulnerable to a pullback or at least a period of consolidation. Swing traders typically try to avoid getting caught in a pullback that may take back part of the gains achieved during a price advance, or sometimes all of the gains if proper risk management is not employed. They should be on the alert for warning signs that indicate a potential end of the short-term trend. In some cases, a warning comes in the form of an opening gap. Since most opening gaps reverse direction intraday, that means it is common for price to decline back to the prior trading session's close, and potentially farther. When deciding whether to exit an opening gap, a trader should check the prior session's close and determine if he would be willing to hold back to that point. If not, the opening gap can be used to lock in additional profits. A stock's volatility should also be considered. If a stock is volatile, an opening gap may be bigger than it appears on a percentage basis. Looks can be deceiving where volatility is concerned. Example: Figure 8.18 shows a daily chart of BioLace Technology Inc. (BLTI). Price rallied for several days from July 23rd to 2007. On July 31st, price gapped up open approximately 6% above the prior session's close. Price had already moved far away from the moving average prior to the appearance of the opening gap. The opening gap offered a swing trader an opportunity to sell near what may turn out to be the swing high. By the close of market, the opening gap had evolved into a bearish dark cloud cover pattern. The surrounding chart landscape should also be evaluated. Look for technical signs that indicate where the trade may run into trouble. Swing traders typically determine targets in advance of initiating their trades. A ceiling above would provide a target. A gap up to that ceiling would indicate the target has been achieved. Conversely, if a short position is held and price gaps to a floor, in most cases the position should be covered. Swing traders should monitor their trades closely and be vigilant at the open. Attention should be given to the circumstances in which the opening gap occurs. If a stock gaps up open to a level where price is vulnerable to a change in direction, it is not necessary to wait to see if the morning gap fills or if a candlestick pattern evolves by the end of the daily session. In many cases, the morning gap is an early reversal signal. Example: Figure 8.19 shows a daily chart of Denbury Resources Limited (DNR), a swing trader who entered a long position when price pulled back to the 50-period simple moving average would have participated in the swing up from July 27th to August 1st, 2007. The July high would be a logical target. Dotted line. On August 2nd, price gapped up open approximately 7% to just above that ceiling. As you can see from the 15-minute price action shown in Figure 8.20, the stock fell rapidly after the opening gap, which pushed it back below the ceiling on the daily chart and filled the gap within the first 45 minutes of trading. It would not have been necessary to hold through that intraday decline had a swing trader determined the target in advance and used the opening gap to exit when that objective had been reached. Morning gaps and pullback swing traders may be concerned about opening gaps filling during the day and robbing them of the extra profits they could have had if they exited the trade earlier in the session. But that is not the only concern. Often, an opening gap marks the beginning of a pullback on the daily chart. So not only are the additional profits in the opening gap at risk, but the stock may decline further during the following days. As a general rule, a short-term trader seeks to exit after a price swing rather than holding through a pullback or consolidation. Not all opening gaps will mark the beginning of a pullback. Morning gaps are very common. Even though most of them may reverse the opening direction intraday, it does not necessarily mean the stock will continue to decline during the following days. Sometimes opening gaps will occur day after day, filling or partially filling each day. But price continues in the direction of the trend, and even if a stock has moved well away from the average prior to the gap up open, There will still be instances in which the stock will continue to rise instead of moving sideways or pulling back. Remember though, that type of scenario is more the exception than the rule. Example, Figure 8.21 shows a daily chart of Claricor Inc., CLC. After a long white shaven candle formed on August 8, 2007, price gapped up open in the following session far above the prior bar's high. Price turned down immediately and quickly filled the opening gap. By the end of the trading session, a dark cloud cover pattern had formed on the daily chart. Although price did not pierce halfway or more into the prior candle's white real body, the penetration was substantial enough to provide the same message as an ideal dark cloud cover pattern. The stock continued to decline over the next several days, retracing most of the prior swing up. There will always be situations where you exit a long position and then watch the stock move higher. That is simply part of doing business in the uncertain world of trading, in which we must make our decisions at the right edge of the chart instead of in the rearview mirror. Don't get caught up in wishful thinking by looking back at a stock like UIC in Figure 8.22 that you may have exited. If your strategy called for exiting, you should commend yourself for following your rules rather than chastising yourself for doing so. Disciplined traders survive in this business. Undisciplined ones rarely do. Example, Figure 8.22 shows a daily chart of United Industrial Corp., UIC. UIC gapped up open every day for several days during May 2007 arrows. Some of the morning gaps were very small, while others were more significant. Even though this stock got far away from the average, it continued to move higher. Some traders may elect to take partial profits in specific cases in the face of an opening gap. For instance, they may sell a quarter, half, or more of their shares and maintain a protective stop on the balance of the position. That action maintains a partial position in the event that the stock continues higher, while reducing the exposure in case price pulls back. Selling in increments is a practice referred to as scaling out. Other traders may prefer to utilize a strategy that includes raising the protective stop or implementing an automatic trailing stop in lieu of exiting when an opening gap occurs. With practice, you'll determine the method that is best suited to your risk tolerance and trading style. Exiting a trade in pre-market. Since it is common for an opening gap to reverse within the first hour of trading, traders do not have a lot of time to ponder how to react to the gap. Traders should decide before the opening bell whether they'll wait until the open and observe the price action, or if they'll attempt to exit the position in pre-market trading. The regular trading session for the major U.S. stock exchanges runs from 9:30 a.m. to 4 p.m. Eastern Time. Pre-market trading occurs for a couple of hours prior to the open of the regular trading session. Participation by market makers and electronic communications networks, ECNs, in pre-market trading is voluntary. Thus, liquidity may be significantly less than during normal trading hours, and some stocks may not trade at all prior to the opening bell. Many novice traders are not familiar with, or have some fear of, trading in the pre-market session. Traders should do so cautiously, as the bid-ask spreads can be significantly wider than during regular trading hours. However, if a trader owns a stock that is trading actively in pre-market, heavily enough that the spread is not prohibitive, exiting in pre-market is a viable option in many instances. Only limit orders will be filled during pre-market hours. Market orders will be held in queue until the opening bell. It is not usually necessary to wait until the opening bell in order to determine if a stock will gap open to the up or downside. If a stock is trading actively in pre-market at a price higher than the prior trading session's close, then it has already gapped up. If it is trading at prices lower than the prior session's close, it has already gapped down. Unless something changes before the opening bell that pushes price back to the prior session's close, it is destined to gap open when the normal trading session begins. Price may move quickly at the opening bell, and slippage can sometimes be severe in a fast-moving stock. Keep that in mind when determining your trading strategies. End of Chapter 8. Chapter 9. Support and Resistance. If you wish to become skilled at technical analysis, it is imperative that you understand its primary focus. The crux of technical analysis is the study of trends. Chapter 7 was devoted entirely to discussion of trend analysis. In Chapter 8, you learned about price gaps, which can also play a part in a trend's development. This chapter adds one more layer to the study of trends by examining the role of support and resistance. Support and resistance play a crucial part in chart analysis, trade selection, and trade management. Support is an area below the current price that traders recognize as a level in which buying may be sufficient to overcome selling pressure. Figure 9.1. When price declines to a floor, it is referred to as a test of support. When support is tested and holds, the price decline is halted, at least temporarily. Bulls step into long positions, and bears cover short positions, keeping price from descending further. Price may reverse direction after testing support, or it may move sideways. If price closes below a floor, it is referred to as a breakdown or a break of support. When support is broken, it is a sign of weakness, and the downtrend may continue. Resistance is an area above the current price, which traders perceive to be a level where enough selling may occur to overcome buying pressure. Figure 9.2. When price rises up to a ceiling, it is referred to as a test of resistance. When resistance is tested and holds, the price advance is halted, at least temporarily. Bears sell short, and bulls exit long positions, keeping price from ascending further. Price may reverse direction or move sideways after testing resistance. If price closes above a ceiling, it is referred to as a breakout or a break of resistance. When price breaks through a ceiling, it is a sign of strength, and the uptrend may continue. Support and resistance levels are not arbitrary. They are areas on a chart that are known to have the potential of halting the trend. The most commonly referenced support and resistance areas are those created from price peaks and bottoms. Peaks and bottoms are formed during a trend's development, and they are also the building blocks of Western reversal and continuation patterns. Resistance and support at peaks and bottoms. As discussed in Chapter 7, peaks and bottoms are formed as a trend develops, and during trendless phases, consolidation. Now it is time to expand upon the roles of peaks and bottoms as areas of resistance and support. Whether they have formed recently or farther in the past, peaks and bottoms have the potential to provide resistance or support, respectively, when price approaches those areas again. As an uptrend develops, price typically rises and then pulls back or consolidates. The price action from those short-term trends leaves a series of minor peaks and bottoms. Some of the peaks and bottoms will be more significant than others, but each creates a potential resistance or support area. Example: Figure 9.3 shows a daily chart of Berry Petroleum Company. From late March through mid-June 2007, price was in an uptrend. After each pullback or period of minor consolidation, price was easily able to surpass the prior peak, numbered 1 through 5, and move on to new highs. Notice how price frequently found support at the prior peak during subsequent pullbacks. For instance, after peak 4 formed, price pulled back and used peak 3 as support. The same occurred again when peak 5 formed and pulled back to peak 4. Prior resistance often becomes new support. The pullback after peak 6 was deeper than the prior dips, but held support at the prior swing low. At 4, price moved up again from early to mid-July, but that time, the momentum was not sufficient to break through the prior peak. At 6, price declined back to support at the June 8th and June 27th bottoms. At 4 again. In order for the uptrend to continue, price must be able to break up through those newly formed peaks to new highs. In addition, when price pulls back, it must hold prior support levels in order for the uptrend to remain intact. Once price is no longer able to take out the prior peak, the stock may either be transitioning into a trading range or putting in a top. Conversely, in order for a downtrend to continue, price must take out each newly formed bottom on subsequent declines. When it is no longer able to do so, the trend may be shifting into a trendless phase or bottoming out. In a scenario like that, which occurred on the chart of BRY in Figure 9.3, when price is no longer able to surpass the prior peak, bearish traders may interpret it as a potential bearish Western double top setting up. They anticipate that a trend reversal is likely. Bullish traders may view the same chart and, rather than seeing a double top, they determine that price has entered a trading range. They anticipate that price will break to the upside at some point, continuing the prior uptrend. The double top that is present on the chart of BRY is just consolidation until it is confirmed with a close below the middle of the M. Thus, it is difficult to determine, at the right edge of the chart, whether the stock is readying for a reversal or just resting before another move up. Only after price has broken down through support or up through resistance will you know whether the bears or the bulls were right. As the BRY example shows, recently formed peaks and bottoms can be strong. Traders who have open positions will watch closely as price tests those areas. But don't underestimate the strength of ceilings and floors that formed farther back on the chart. Price may reverse at a visible support or resistance area that formed weeks, months, or even years in the past. If you compress a daily chart and look back across its horizon, you'll often see very noticeable high and low points where the trend reversed direction. Those major support and resistance areas may even be 52-week highs or lows for the stock. When price approaches such an obvious ceiling or floor, the trend is vulnerable once again to a change in direction. Those areas may be tested again and again. It is a significant event when such a strong support or resistance area is finally broken. Example: Figure 9.4 shows a daily chart of General Motors Corp. (GM), which is compressed so that over a year of data is displayed. The horizontal trend lines show major support and resistance areas on the chart where the stock trended back and forth between $28 and $38. Those are not just minor peaks and bottoms within an up or down trend that can be surpassed easily. Those peaks and bottoms create a significant floor and ceiling for the stock. Price was approaching the floor again at the time of this writing. If viewing only a few months of data on a daily chart, you may not recognize when a stock is traversing between a major floor and ceiling. The moves between those points are literally intermediate term, or in some cases long-term, up and down trends on the daily chart. If you compress the daily chart to show a couple of years of data, or shift up to the weekly time frame, you'll have a clearer view of the big picture. Example: Figure 9.5 shows a chart of General Motors Corp. Again, but this time from a weekly vantage point. The intermediate term up and down trends between $28 and $38 on the daily chart form a trading range, or rectangle, on the weekly chart. You can also see that the ceiling of that weekly trading range formed at prior resistance at a prominent ceiling from 2005. The GM chart in Figure 9.5 is a testament to the value of analyzing more than one time frame. When analyzing a chart of a stock, always glance at the time frame one level higher than the one you are trading on to check for prominent support and resistance areas that may not be visible on the lower time frame. For example, if the daily chart is the main time frame you trade, the weekly chart is the next higher time frame. Round numbers. Periodically, a stock will have trouble moving past a round number. This occurs most often at intervals of 5 or 10, prices ending in a 5 or a 0. Example: Figure 9.6 shows a weekly chart of Rogers Corp. (ROG). A significant floor was formed back in 2005 that would not be visible on the daily chart. Price bounced at that floor in September 2007. For example, 25, 50, or 75. The 100 level, the century mark, is significant, and it is not unusual to see a stock pull back after reaching that level. Round numbers are invisible barriers, and thus do not provide support or resistance nearly as often as visible barriers such as prominent peaks and bottoms. If a stock retreats from a round number one or more times, though, that price action itself will set up a visible ceiling or floor at that level. It is fairly common for major market averages to stall at levels that end in hundreds or thousands. They are psychologically charged numbers that are watched closely by traders. For instance, it was a very significant event when the Dow Jones Industrial Average finally broke up through the 10,000 level. Example: on the daily chart of Varian Inc. (VRI), shown in Figure 9.7, the uptrend halted at $60 in March 2007. The March high was tested again several times during April to May. The stock was unable to close above that resistance area. Finally, on July 27th, price broke through $60 and closed above the strong ceiling. Trend lines. A trend line can be drawn below and connecting bottoms in order to highlight a support area, or above and connecting peaks in order to highlight a resistance area. The more times the support or resistance area is tested, the stronger it becomes. When a very long or strong trend line is broken, many traders will observe the event. Trend lines may be drawn horizontally, connecting price peaks or bottoms to help identify the approximate boundaries of a trading range, see Figure 9.5, or a major ceiling or floor, see Figures 9.4 and 9.6. They may also be drawn at an angle connecting rising or declining peaks and bottoms in order to identify the slope and length of the trend. Refer to Chapter 7 and Figure 9.16 in this chapter. Trend lines make it easy to see when price has closed above resistance or below support. Other areas of support and resistance. In addition to peaks and bottoms, price may also find support or resistance at the beginning of a gap and at strong moving averages. Gaps may provide support or resistance. As discussed in Chapter 8, a true gap is formed between two consecutive bars when the current bar gaps above, gap up, or below, gap down, the prior bar's range. This price action leaves a void on the chart in which no trading took place. It is common for price to trade back through that void and close it. When a stock gaps up, The bottom of the void may provide support when price declines back down to that level. The beginning of the gap up is the high of the bar prior to the gap up bar. Price may trade below the gap intraday, leaving a lower shadow, but it should close the session above it. If price closes below the gap, the support area has been violated, and the implication is bearish. Example: Figure 9.8 shows a daily chart of Crane Company (CR). Horizontal lines have been drawn to indicate where price gapped up and later filled the gap, which provided support from which price moved higher. That scenario occurred twice on this chart, first in March 2007 and again in May. When a stock gaps down, the top of the void may provide resistance when price rises back up to that level. In this case, the beginning of the gap is the low of the bar prior to the gap down bar. Price may trade above the gap intraday, leaving an upper shadow, but it should close the session below it. If price closes above the gap, the resistance area has been overcome and the message is bullish. Example: Figure 9.9 shows a daily chart of Estée Lauder Companies Inc. (EL). The horizontal line indicates the resistance area at the beginning of the gap, which was tested 1. on August 27, 2007. Price retreated and then tested the resistance area again 2. in late September. Regardless of whether a gap is filled shortly after it is formed or weeks or months later, the beginning of the gap has the potential to provide support, gap up, or resistance, gap down. Price will not always fill the whole gap. The entire vacuum between the two consecutive price bars may act as a zone of support or resistance. Moving averages may provide support or resistance. Unlike most other indicators that are plotted in panels below the chart or above it in some charting programs, moving averages are plotted directly in the chart window. As the use of technical analysis has become more popular and widespread, certain moving average lengths have gained recognition. For instance, the 50 and 200 period moving averages are closely monitored by traders. These moving averages have the potential to provide support or resistance because traders tend to react, buy or sell shares, as price approaches them. The 50-day moving average is a strong intermediate-term average. It is approximately equal to the 10-week moving average, 5 trading days per week, times 10 equals 50, which is often used by traders who view charts on the weekly time frame. In other words, when price bounces at the 10-week moving average on the weekly chart, it is bouncing at the 50-day moving average on the daily chart. Example: Figure 9.10 shows a daily chart of AMB Property Corp. (AMB). The stock was in a downtrend from May through August 2007. Every attempt to break up through the 50-period simple moving average (SMA) during that time was met with failure. The 200-day is a long-term moving average. It is approximately equal to the 40-week moving average. 5 times 40 equals 200. So it is also monitored by many traders who utilize daily and/or weekly charts. Price tends to gravitate toward it during a correction of a trend. Moving averages are derived from price. They do not generally provide support and resistance as readily as price peaks and bottoms that are created from the actual price action. However, do not underestimate the ability of the 50 and 200 period moving averages to stop a stock's move, at least temporarily. Those two moving average lengths tend to be strong on all time frames, even though the correlation to the weekly chart mentioned previously is applicable only on the daily time frame. Many novice traders are not aware of the correlation and simply adopt the use of the 50 and 200 period moving averages, assuming they will work on various time frames, and often they do. Debate over simple versus exponential. The simple method of calculating a moving average was presented in Chapter 7 and is the most commonly used. The simple method assigns equal weight to each day's price that is included in the average. There are other ways to calculate a moving average, including assigning a different weight to one or more of the prices in the set. One such method that is popular among traders is an exponentially smoothed moving average that weights the most recent prices heavier than the older prices. Whether you use simple or exponential moving averages is a matter of personal preference. Fortunately, mainstream charting programs do the calculations for us, and users are given the option of selecting either simple or exponential. SMAs are used exclusively in the chart examples provided in this book for consistency, and to avoid displaying a busy chart that may distract from the technical events being emphasized. However, I do monitor both simple and exponential moving averages, EMAs. Many mainstream charting programs offer users the ability to configure multiple chart templates. Different indicators can be assigned to the various templates if desired to avoid indicator overload on one template. One of my templates includes both the exponential and simple version of the 50 and 200 period moving averages. I can quickly jump to that template whenever I need to determine which version of the average appears to be more powerful for the particular stock or index that I am evaluating. Some stocks may find support or resistance at the SMA, and some at the EMA, or both. Therefore, it certainly doesn't hurt to plot both versions in the chart window. Some traders may argue that the SMA is the only one that matters, and there is no sense in looking at the EMA. I do not agree, and could provide numerous examples in which the EMA was quite strong. Example. A case in point is a stock that I trade periodically, Shaw Group Inc., SGR, and Forejikit. Figure 9.11 shows a daily chart of SGR. In the past, this stock has had a tendency to obey both the 200-day SMA and the 200-day EMA. See circled turning points. Without viewing both versions, one would not be aware of this fact. Example. If you still are not certain that the EMAs are worth monitoring, take a look at Figure 9.12, which shows a daily chart of the Nasdaq Composite Index. In February and March 2007, the broad market sold off sharply and then bottomed out. The Nasdaq Composite Index formed a bullish double bottom, dotted line, at the 200-period EMA. Similar events occurred on the charts of the following indexes during that time period: the Dow Jones Industrial Average, the S&P 500 Index, and the Russell 2000 Small Cap Index. Support and resistance areas are not rigid barriers. Support and resistance levels are not rigid, inflexible barriers. Don't expect price to always make an abrupt turn precisely at a floor or ceiling. Price may turn a bit before or move slightly beyond those boundaries. Therefore, they should be considered zones of support and resistance rather than exact turning points. Example. Figure 9.13 shows a daily chart of Drillquip Inc., DRQ, which was trapped in a trading range for a few months. The horizontal trend lines illustrate the approximate upper and lower boundaries, revealing the rectangular shape. Failure of support or resistance levels. As mentioned previously, minor support and resistance levels are formed as price surges and then consolidates or pulls back. Price typically forms a series of peaks and bottoms in the general direction of the trend. Those short-term moves create temporary interruptions of the trend. In order for the trend to continue its direction, those barriers must eventually be overcome. Even very strong support or resistance areas are not infallible. Support and resistance levels are not permanent barriers. Investors' expectations change over time. Eventually, most support and resistance levels are broken, and traders accommodate the new higher or lower prices. There are a variety of events that may cause the break of a strong floor or ceiling, including the following. News may be released that impacts a company's stock. Funds are regularly rotated from one asset class, sector, or industry group to another based on economic principles such as the business cycle or monetary policy, an actual or anticipated change in a company's fundamentals. For example, a stock may break out above resistance or break down below support when earnings are announced or if the company releases guidance for upcoming quarters. A broad market rally or sell-off may raise or lower most stocks, regardless of their financial worthiness. When the Dow Jones Industrial Average fell over 400 points on February 27, 2007, support levels were irrelevant. All of the major averages sold off, and many stocks plunged through previously strong support levels that day or in the following days. Support and resistance reverse roles. Once support or resistance has been broken, it is very common for it to reverse roles on the other side. And when a stock breaks down through a floor, it often becomes a ceiling above price, and vice versa. This phenomenon is commonly seen when price peaks or bottoms are broken. The support-resistance role reversal may occur soon after the breakout or breakdown. Often, price turns right back for a test of the prior ceiling or floor. See Figure 9.14. That price action offers traders a low-risk opportunity to get aboard the trend when price pulls back, rather than chasing a runaway stock. The stock often continues in the direction of the breakout or breakdown after pulling back. Volume may offer an important clue as to the strength of the new move. Example. The upside breakout on the daily chart of Myriad Genetics Inc. (MYGN) in Figure 9.14 was accompanied by heavy volume. Volume declined during the pullback, dropping below average as the prior ceiling was tested as support. That was a good indication that the new higher price level had been accepted. Even if price does not pull back immediately, it is common to see a prior ceiling or floor tested weeks or even months later during a correction of the trend. Sometimes support and resistance reverse roles multiple times. The more tests of support and resistance, the stronger that area becomes. Price is likely to reverse or consolidate there again in the future. Example: on the daily chart of Ryerson Inc. (RYI), shown in Figure 9.15, resistance that formed in March 2007 was broken in April and became new support. Once that support level was broken in May, it became resistance once again. The reversal of roles may occur when horizontal support or resistance is broken, but it may also occur when an angled trend line is broken. It is also not unusual for a strong moving average, such as the 50 or 200 period, to reverse roles when broken. Example: on the daily chart of Omni Energy (OMNI), shown in Figure 9.16, price trended up for several weeks off the January 2007 low. That strong support trend line was broken in April. Once the uptrend resumed in May, that prior support trend line was tested as resistance several times. Example: Figure 9.17 shows a daily chart of Galinas Arias (GOL). In February 2007, price rallied up to the 200 period SMA1. Price retreated from that strong average for a few weeks and then rose up to test it again. On March 31st, price gapped up open above the average, but the bulls could not sustain the new high and price closed below it, too. Not only was the 200 period SMA tested at 2, but the February high, 1, was at about that same level, offering even more resistance. Finally, in May, price punched up through the average and moved to a new high before pulling back toward the average. On June 8th, price gapped down open, 3, after the short-term decline and pierced the prior session's long black real body, leaving a bullish piercing pattern with the 200 period SMA below for support. Candlesticks at support and resistance. You may be surprised to discover how often candlestick reversal patterns form at or near support and resistance areas. And recall from Chapter 5 that long shadows are common at those areas, whether or not the candlestick lines meets the criteria of a specific reversal pattern. One or more long shadows are evidence of traders reacting when price tests a support or resistance area. A daily chart of McDonald's (MCD) is displayed in Figure 9.18. The stock has been consolidating for a few months. The horizontal trend lines identify the ceiling and floor of the trading range. The following analysis explains the events that occurred at the turning points as the trading range developed between May and July 2007. The numbers that follow correspond to the numbers on the chart. 1. A bearish hanging man, 1, formed after 2 long white candles. Because the candle prior to the hanging man was a long white candle, it could also be interpreted as a bearish harami pattern. Price pulled back for a couple of days before moving higher. 2. After a strong swing up, a bearish hanging man, 2, formed on May 18th. Price declined from there back to the May 2nd peak at 1, where it found support. 3. 2 long lower shadows, 3, formed on May 29th and 30 as the May 2nd peak was tested as new support. The May 30th lower shadow was long enough for many traders to interpret it as a hammer. 4. Price rallied back up and found resistance at the May high. A long upper shadow, 4, formed there on June 19th. It was nearly long enough to be a shooting star. That shadow showed that there was an intraday breakout above the May high, but the bulls were not able to sustain the breakout. 5. Price declined back to the floor that had been established by the May 2nd peak at 1 and the May 30th bottom at 3. Notice the long lower shadows, 5, that formed as price tested support. That showed the willingness of bulls to step into long positions at the support area. 6. Price did not make it all the way back to the top of the trading range before turning back down to test the floor again. A bullish piercing pattern, 6, formed on July 11th at support. 7. Price made another swing up across the channel. The long upper shadow, 7, on July 13th, was an indication of selling near the strong resistance level. The stock gapped up open the next morning, reversed immediately at the ceiling, shaven top, and filled by the end of the session, leaving a morning gap. Not all reversals at support and resistance levels will include a candlestick signal, but many do. End of Chapter 9. Chapter 10. Putting Candlestick Reversal Patterns to Work. Now that you have learned about the primary candlestick reversal patterns and some basics of Western charting, it's time to determine how you'll put the reversal signals to work. The candlestick reversal patterns may be used by traders in several ways, including the following. Trading opportunities. Traders may initiate trades based solely on the presence of a candlestick pattern. Reinforce another setup. Traders may look for candlestick signals that form in conjunction with larger price setups, or where price is testing support or resistance. Warning to take profits. Traders may interpret a reversal pattern as a warning to exit an open position, or at least take a defensive stance. This chapter will address these uses for the reversal signals, as well as provide some suggestions for finding patterns and controlling risk to your capital. In-depth instruction on risk management and trade management is beyond the scope of this book. Novice traders are strongly advised to pursue additional study of those topics. Practice spotting candlestick patterns. It takes practice to convert knowledge to skill. Before you can utilize the candlestick patterns, you must be able to recognize them. Schedule some time to immediately start evaluating charts in order to develop your pattern recognition skills. You may need to review Chapter 3 a few times first, so you feel certain that you understand the psychology behind each of the primary reversal patterns. A quick reference guide is also provided in Appendix A. The goal is to train your eye to quickly spot candlestick reversal patterns. Evaluate many charts, one after another. The repetition will be helpful. If you are not sure what stocks to evaluate, select some symbols from the S&P 500 index component list included in Appendix B. Focus primarily on the turning points, peaks and bottoms, on a chart, and you'll locate reversal patterns. If a chart is messy and hard to decipher, just skip past it. When you locate a reversal pattern, make note of the surrounding chart landscape. Did the pattern form at a support or resistance area? Did the stochastic oscillator confirm the signal? Was it an ideal reversal pattern? Or was it a non-ideal pattern or variation? Is a strong reversal pattern, such as an engulfing pattern or a hammer, accompanied by heavy volume? Eventually, it will not only be very easy for you to recognize the reversal patterns, but you'll learn to look for supporting Western technical occurrences that assist you in determining which signals are most likely to follow through. Once you are able to recognize the patterns, you can determine how you'll implement them in your trading. As part of your analysis, don't forget about the bigger picture. Consult the charts of the broad market averages, the Dow Jones Industrial Average, the S&P 500 Index, and the Nasdaq Composite Index. While browsing through charts, you may notice that between certain dates, a lot of bullish patterns seem to fail. That may result in your questioning the validity of the signals, but perhaps that occurred during a time when the broad market was selling off. Remember that stocks, regardless of how bullish a setup or how good the company fundamentals, may be pulled down during a broad market decline. Conversely, if the market is rallying, even stocks with weak charts and/or poor fundamentals may get a temporary boost. Reversal patterns provide trading opportunities. The candlestick reversal patterns can be utilized for trade setups. Recall that a setup is an identifiable price formation that presents a potentially profitable trading opportunity. Among the numerous setups for traders to choose from are candlestick patterns. A strategy is the method a trader uses to trade a setup. Some traders may wish to devise a strategy for trading one or more of the candlestick reversal patterns. Bullish reversal patterns can be used to initiate long positions, and bearish patterns for short positions. Traders cannot be certain that a candlestick pattern is present until the close of the trading session. Therefore, if trading a candlestick signal, a position may be entered very near the end of the session on the signal day, or after the open of the following session. As indicated in Chapter 3, for some reversal patterns, it is best to wait for confirmation before entering a position. Make sure to carefully review the criteria and psychology of each candlestick pattern you wish to trade. Searching for reversal patterns. For centuries, the Japanese did not have the aid of computers for chart analysis. They fared quite well using a trained eye to find the formations on charts that were drawn by hand. Of course, that was before the days when there were thousands of stocks available to trade. If you trade a single instrument, such as the S&P Mini, or a limited number of stocks, you won't need to run computerized scans to find reversal patterns. Patterns can be located simply by evaluating the charts. In fact, it would be beneficial to recognize and understand all of the reversal patterns presented in Chapter 3 in order to expand the trading opportunities rather than waiting for just one specific pattern to form. Some traders may prefer to trade one or more specific candlestick patterns. In that case, they'll need to flush out the stocks that meet the pattern's criteria so they can choose good-looking setups from among them. There are currently about 7,000 stocks traded on the three major U.S. exchanges: the New York Stock Exchange, NYSE, the American Stock Exchange, AMEX, and the Nasdaq. Traders who wish to find a particular reversal pattern among hundreds or thousands of stocks can save a tremendous amount of time by allowing the computer to do most of the work. Computerized screening. The ever-increasing power and speed of personal computers has made searching for candlestick patterns easy. Many of the mainstream charting programs offer users the capability to code the criteria that identifies the patterns. Users can quickly scan for candlestick patterns among the thousands of stocks traded on the exchanges. Coding the candlestick patterns. Those who wish to trade one or more of the candlestick reversal signals and scan for them among a large number of stocks will need to define the criteria for each formation. For instance, telechart users can create personal criteria formulas, PCFs, for the patterns. The PCFs can then be used to sort or scan for stocks that meet the pattern's criteria. Fortunately, the criteria of all the patterns have already been defined by traders who were generous enough to share that information with others. Telechart users can access www.tradion.com, a free website, to obtain the formulas for candlesticks. The website includes the code for all of the candlestick lines and the reversal patterns discussed in this book, as well as several reversal and continuation patterns that were not covered. On the homepage, click the down arrow to the right of Beginners and Misc Information and select Candlestick PCF Tutorial. Figure 10.1. On the Candlesticks page, use the scroll bar to the right to search for the candlestick patterns you wish to trade. Figure 10.2. A PCF must be created in Telechart for each candlestick pattern. The code can be highlighted and copied from the tradion.com webpage and pasted directly into a PCF in Telechart. For more information on Telechart, visit the website at www.telechart.com. Traders who do not use Telechart should contact the vendor of their charting service to inquire if there are similar online resources where users share code in that program's language. Even if you cannot find such a resource, you can use the code from tradion.com to extrapolate the criteria for the various patterns and write it in the language of your charting software. The language for each charting platform may differ some. However, the coding concepts are usually similar. For example, TradeStation is a powerful charting platform. Their proprietary easy language allows users to designate criteria for screening. For more information on TradeStation, visit the website at www.tradestation.com. Those who wish to utilize the TradeStation platform can get a substantial discount off the monthly fee by opening a brokerage account with them. The software is linked to their brokerage services. If you are a Metastock user, the code has been written and is available for purchase as a plugin. For more information about Metastock, visit the website at www.metastock.com. Filter for price and volume traders can also reduce the number of stocks to be analyzed by utilizing a price and volume filter. This is a great technique to use in conjunction with a scan that isolates a specific pattern from among a large number of stocks. Such a filter can be used to narrow down the stocks in any scan or list of stocks, not just candlestick scans. First, determine the price range of stocks you wish to trade. The desired price range may vary widely from one trader to the next. If you are not sure what price range to select, consider using a simple model based on account size. Say Trader A has a trading account of $50,000. For that account size, I don't recommend investing more than 20% of the account in the stock of one company. Therefore, no more than $10,000 could be used to purchase one stock, and the trader could purchase up to 5 stocks in this account, or more if less than $10,000 is committed per stock. Personally, I don't typically buy a stock that I cannot afford at least 200 shares of, but at a minimum, I'd recommend figuring for no less than 100 shares. Less than 100 shares is referred to as an odd lot. Divide $10,000 by 100 shares for a maximum price per share of $100. Or divide $10,000 by 200 shares for a maximum of $50 per share. Next, determine the minimum share price. For instance, many traders elect to trade stocks that are $5 per share or higher because stocks below $5 may not be marginable. Using these parameters, the price range would be $5 to $50 if you wish to trade a minimum of 200 shares, or $5 to $100 for a minimum of 100 shares. Think of the model outlined above as trading within the means of your account. Most aspiring traders who do not succeed in this business fail due to poor risk and money management methods. Diversification and position sizing are two very important factors to consider. Example: Google, GUG, is currently trading above $500 per share. Buying shares of Google could tie up a substantial amount of capital, which may not be a challenge for a large account, but could be problematic for a smaller account. Trader A would have to invest his entire account of $50,000 in Google just to buy 100 shares. That would be an error in judgment, as the account would be over-allocated to one stock. If Google got unexpected news one evening and dropped 10% the next day, Trader A's entire account would be drawn down by 10%. However, if trader A limited the purchase of one stock to 20% of the account, and the stock fell 10%, the trader's account would be drawn down by only 2%. In addition, implementing a rule for diversification will keep him focused on stocks that are priced appropriately for the account size. Trader B has a larger account of $250,000. Putting 20% or $50,000 into one stock would mean a lot more exposure in one company. Trader B should break her account down further, for example, into 10 blocks of $25,000 or 15 blocks of approximately $16,500. That means managing more trades in order to get the account fully invested. That is a quality problem. There are different schools of thought on the best way to determine position sizing and for diversifying one's account. The above referenced model was presented because it is simple for novice traders to understand and implement. As traders gain experience, they should study various risk management models to determine which is best suited for their trading style and risk tolerance. Regardless of how you ultimately decide to invest your account, it is paramount that protection of capital be the top priority. Using stop-loss orders to limit loss is another way to protect your capital. Once you have determined the price range for the stocks you'll trade, it is time to think of the stock's liquidity. Decide on the minimum average volume per day you'll require for a stock to be deemed liquid enough to comfortably trade. Again, that level may vary from one trader to the next. Example: with few exceptions, I trade stocks ranked in the 50 to 99 percentile for average daily volume over the past 90 days. That equates to a minimum of approximately 125,000 shares per day. I periodically trade stocks below the 50 percentile, but the majority of my trades are above that level. Novice traders may elect to start with more heavily traded stocks to avoid problems with order fills and excessive slippage. For instance, stocks in the 70 to 99 percentile trade a minimum of about 500,000 shares per day. Combine the two concepts outlined above into one filter, and you have the following price-volume criterion for an account of $50,000. Average daily volume of 125,000 shares or higher, if designating the 50 to 99 percentile, and stocks that are priced between $5 and $50. By using such a filter, you'll eliminate all the stocks that don't fall into your price volume parameters. Then you can scan the remaining stocks for the candlestick patterns or other setups that you wish to trade. Your charting program may have a feature that allows you to create a price volume filter and apply it to any list of stocks. In Telechart, both the price and volume filters can be designated by creating a single easy scan. The price volume easy scan can then be laid over any watch list or over any other easy scan using Telechart's sublist feature. If you use Telechart and are not familiar with the scanning and sublisting processes mentioned in this chapter, contact the vendor for training materials, or feel free to email me for assistance. You can reach me at tina@tinalogan.com or through my website at www.tinalogan.com. If you use a program other than Telechart, I encourage you to contact the vendor and inquire if similar filtering techniques are available in their platform. It is not my intention to steer you toward using Telechart. Many mainstream charting platforms include some type of screening mechanism. You must decide which charting service is best suited to your trading needs. It is important, though, if you intend to search for setups among a large number of stocks, that you understand such tools and features are available with a good charting program. It may help you distinguish one platform from another when determining where you'll spend your money. Example: Figure 10.3 shows the Telechart watchlist window. A scan for bullish engulfing patterns was run with a price volume sublist applied. On the day this scan was run, October 5, 2007, only 168 of over 7,000 stocks met the criteria of a bullish engulfing pattern. But once the price volume sublist was applied, only 33 stocks remained. You can see how this dramatically reduces the number of stocks to be evaluated. Limitations of computerized scanning computers can reduce the amount of work required to isolate stocks that exhibit a certain candlestick pattern. That does not release the trader from the responsibility of knowing the psychology of the pattern, as well as an understanding of Western technical analysis. A computer cannot discern whether one pattern appears to be a more viable candidate than another. A computer cannot look across the chart landscape and see where areas of support and resistance lie that may help or hinder a stock's movement. It cannot spot a divergence, nor can it tell you whether there is an adequate reward-to-risk ratio to justify a trade. A computer can only narrow down a large list of stocks to a much smaller list of potential trade opportunities. After that, it is up to you to review that list, making a visual inspection of each chart and further reducing the number of stocks to only those that merit the commitment of your funds. Another challenge with computerized screening is that a non-ideal pattern or a slight variation of a pattern may be excluded because it falls short of meeting the requirements designated in the formula. Remember that non-ideal patterns and variations can be just as strong as some ideal patterns when considered in the context of the surrounding price action.
Reward versus risk. In Chapter 3, reference was made in regard to several of the reversal patterns that, by the time the signal is apparent, there may not be an adequate reward-to-risk ratio to justify a trade. The reward versus the risk should be considered before entering a trade, regardless of whether it is a candlestick pattern or some other price setup. If the potential reward does not outweigh the risk involved by a sufficient amount, a trader should pass on the trade or wait for a better entry opportunity to set up. The reward is the potential profit on the trade. It is the gain that a trader will recognize if a trade moves from the entry price to an exit point he has determined based on analysis of the chart. That exit point is referred to as the target or price objective. The risk for a trade is the amount of money that will be lost if the trade does not follow through as anticipated. It is the distance from the entry price to the point where the trader has determined that the position will be exited because it has failed. The failure point is where the initial protective stop-loss order would be placed. The reward compared to the risk is often referenced as a ratio. To calculate the reward-to-risk ratio, simply divide the amount of potential reward by the amount of potential risk reward. For example, if the distance to the target is 4 points and the distance to the protective stop is 2 points, the reward-to-risk ratio is 2. There is twice as much potential reward as risk. A ratio of 1 means that the potential risk is as great as the potential gain. That is a poor ratio. The higher the reward-to-risk ratio, the better the trading opportunity. I suggest always trying to select trade setups that will net at least twice as much potential gain as loss. And ideally, that ratio will be 3-to-1 or better on many trades. Example. Figure 10.4 shows how to compare the reward to the risk. A trader is considering entering near the close of the bullish engulfing pattern at the right edge of the chart. There is an area of resistance overhead that offers a reasonable target for a swing trade. The low of the bullish engulfing pattern is the failure point for this setup. The distance to the target, reward, is about 2.5 times the distance to the failure point. Risk. Example. Figure 10.5 shows a daily chart of Pier 1 Imports Inc. PIR. The stock was in a downtrend during July 2007. Price accelerated to the downside in late July and early August, moving far away from the 20-period SMA. That short-term oversold condition was alleviated by a rally from August 6th to 9th. On August 9th, a spinning top formed after the prior day's long bullish candle, creating a bearish star pattern and alerting that the rally may be running out of steam. It was followed in the next session by a strong bearish engulfing pattern. A swing trader might use the engulfing setup to initiate a short position. The swing target, reward, would be to resistance at the August low. The failure point, risk, would be to the high of the engulfing candle. The reward-to-risk ratio would be only about 1.5, not enough to justify the trade. Swing trading strategies typically call for determining the failure point and price target. Thus, determining the reward-to-risk ratio in advance of initiating a trade is part of a swing trader's work when evaluating the viability of a setup. Trend-following strategies may not call for determining price objectives, since the goal is to enter a trending stock and ride the trend until it reverses. Even if a trader does not have a specific price objective for a trade, it is still prudent to enter where the initial stop would not be prohibitively far away. Don't forget about volatility. Even if a setup provides an adequate reward-to-risk ratio, it does not necessarily mean it merits an entry. Using the example of PIR in Figure 10.5, if a short position were entered near the close of market with the protective buy-to-cover stop a little bit above the high of the bearish engulfing pattern, the stop would be about 10% away. For swing trades, I have a general risk control rule that my stop should never be more than 10% away from the current price of the stock. Thus, the PIR entry would be right at my maximum allowed for a stop. I prefer to trade setups that offer an entry that is closer to the failure point to minimize the potential loss and improve the reward-to-risk ratio. I look at both the reward-to-risk ratio and how far, percentage-wise, the stop would be from my entry price. If a stock is quite volatile, even if the reward-to-risk ratio is adequate, the stop may be too far away. In such a case, I'll either skip the trade or shift to an intraday strategy to trade the stock. Remember, the 10% maximum for a swing trade is not to be used as an arbitrary stop level. The stop should be placed at the failure point,
but not to exceed 10%. Reversal patterns may reinforce other setups. Rather than entering trades based solely on the presence of candlestick reversal patterns, traders may look for patterns that form in conjunction with larger price setups. For example, a bullish candlestick reversal pattern may form the second bottom of a larger Western double bottom pattern, as shown in several examples throughout this book. I refer to these setups as a pattern within a pattern. This is one of the uses for candlestick patterns that I favor. The presence of a candlestick pattern within a larger pattern, such as the hammer that formed the potential double bottom in the STJ example, figure 10.6, provides an opportunity for an assertive entry into a long position for traders who prefer not to wait for the larger double bottom pattern to confirm. For a double bottom to confirm, price must close above the peak between the two bottoms. Bottoming patterns often form as a long downtrend is coming to an end, or at that completion of a correction of a long-term uptrend, and vice versa for topping patterns. Traders wishing to get aboard a new trend or a resumption of the trend as early as possible may favor setups such as the STJ example. Protective stops should be used to limit loss in the event the bottoming pattern is not successful at reversing the trend. Support and resistance. Another application for the candlestick reversal patterns is to choose setups that form at support, bullish patterns, or resistance, bearish patterns. As discussed in Chapter 9, price often finds support or resistance at prior price peaks and bottoms, strong moving averages, and at the beginning of a gap window. Some traders, myself included, may feel more comfortable entering bullish patterns, such as those shown in the FLR example, figure 10.7, where there is support below, rather than if they form during a decline in which there is no visible support that will attract the attention of market participants. This approach works well for swing trading strategies, but also can be employed for entry into longer-term positions. Example, figure 10.6 shows a daily chart of St. Jude Medical Inc., STJ. In February to March 2007, price declined and found support at the 200-period simple moving average, SMA, on March 14th. Another test of the 200-period SMA occurred on March 30th, setting up the potential for a Western double bottom reversal pattern, dotted line. The March 30th candle was a hammer. Convergence of signals. The setup shown in figure 10.6 was very desirable because there was a convergence of signals. Signals converge when there are two or more bullish or bearish events that intersect. In this case, not only was there a candlestick reversal signal, hammer, within a Western reversal pattern, double bottom, but there was support below provided by the 200-period SMA. Figure 10.7 also provided a convergence of signals. Even with a convergence of signals, there is no guarantee that the setup will follow through as anticipated. However, with several signals present, many traders will notice the setup increasing the likelihood of a successful outcome. Example, figure 10.7 shows a daily chart of Fluor Corp. FLR. After a price decline, price gapped down open on June 8th to near the 50-day SMA reverse direction and closed well into the prior black candle's real body, leaving a bullish piercing pattern. In addition to the strong moving average just below, the horizontal line drawn on the chart shows that there was additional support provided by prior minor peaks and bottoms that formed in April to May. Another swing up followed the piercing pattern, ending with a northern doji near the June high. Price pulled back again from June 18th to 26th. Price gapped down open on June 27th, tested support again at the 50-day SMA and the prior bottoms, and closed the session as a bullish engulfing pattern. In summary, although I will periodically trade a candlestick pattern in isolation, it is my preference to trade those that form where there is additional ammunition for a move in the anticipated direction. As long as there are many trade opportunities to choose from, I'll always gravitate toward the setups that offer a higher likelihood of following through. When I do trade based strictly on the appearance of a candlestick signal, I look for confirmation from other technical tools, such as volume and/or the stochastic oscillator. Even traders who wish to run computerized scans looking for specific candlestick patterns can apply these Western techniques in order to isolate the most promising setups. Reversal patterns can provide warnings. Another effective way to utilize the candlestick reversal signals is for warnings to lighten up or exit an open position. This is especially helpful for swing traders who hold positions for a few days to a few weeks. Rather than holding on as the market zigs and zigs like a longer-term investor may do, the swing trader exploits the short-term moves within a trend. Candlestick reversal signals can be used to exit a trade, or at least take a defensive stance, for those who do not wish to hold through a potential pullback or period of consolidation. Swing traders holding long positions should watch for bearish reversal signals. Those holding short positions should watch for bullish reversal signals. A challenge with utilizing the reversal signals in this manner is that you won't know until the close of the trading session that the pattern is present. As discussed in chapters 2 and 4, the candlestick can change shape throughout the session, so a close is necessary in order to identify the pattern. For some reversal patterns, that means price may have moved significantly against your position by the session's end, for example a dark cloud cover or an engulfing pattern, as you wait to see how the candle looks by the end of the session. Recall from discussion in chapter 8 though, that many times a reversal pattern will begin as an opening gap. Swing traders may elect to exit a position that gaps after a directional move. By the end of the session, it won't matter if a strong reversal candlestick pattern has formed, because you'll have used the gap to exit early in the day. Another option is to lighten up by selling part of the position on the opening gap, or in pre-market trading, and maintain a protective stop on the balance of the position. Short selling. Several times in this book you've seen reference to shorting a stock. For instance, some traders may utilize bearish candlestick signals to initiate short positions. Shorting is a confusing concept for many novice traders, but it really need not be. Selling short is the opposite of going long. Instead of buying and then selling, the trader is selling and then buying. When a trader enters a long position, shares of the stock are purchased in anticipation that the price will rise and the stock will be sold at a higher price. When a trader enters a short position, the shares are sold in anticipation of a price decline. If the stock declines, the shares can be bought at a lower price, which is referred to as covering. Example: if a long position is taken on a stock at $50 and the stock rises to $60 and is sold, the trader recognizes a gain of $10 per share. If a stock is sold short at $60 and covered at $50, the trader recognizes a profit of $10 per share. Short selling has some restrictions. The shares must be borrowed from the brokerage firm in order to sell short. The broker may not have shares in their inventory to lend, so traders should not assume they'll always be able to execute a short position. If demand is high to short the stock, the broker may not have shares available at the time you wish to borrow them. You may be notified later by the broker when shares do become available. However, in some cases, by the time that occurs, the trade is no longer desirable. A margin account is required in order to sell short, because the shares must be borrowed. Therefore, short selling is not allowed in tax-deferred retirement accounts because they are non-margin accounts. Until recently, there was an uptick rule for shorting stocks. That meant price must trade higher than the last price before an order to sell short could be filled. The rule, which was implemented by the Securities and Exchange Commission (SEC) back in the 1930s in order to curtail a bear raid on a stock, was eliminated in July 2007. Novice traders often shy away from shorting due to lack of understanding and a sense that it is a risky practice. Some traders cite the concern that there is no limit to how high the stock's price could rise, thus setting up the potential for unlimited loss. However, traders should not find themselves in this position if they implement proper risk and money management rules. It is not the practice of shorting that is risky, but rather the actions of the trader who fails to protect his capital. Just like with a long position, a protective stop order can be used to limit loss on a short position. A protective stop loss order for a long position is called a sell stop. It is placed below the current price at a level where the trader would no longer wish to hold a position in that stock. For a short position, a buy stop or buy to cover stop is placed above the current price at a level where the trader would no longer wish to be short the stock. Short selling offers traders the opportunity to take advantage of a declining market. I once heard it said that the bull walks up the stairway but the bear jumps out the window. This is a clever way of saying that prices tend to fall faster than they rise. Experienced traders can profit handsomely in a down market. For new traders, though, it is usually best if they become skilled at trading the long side first and then begin to develop their shorting skills. ProShares ETFs, exchange-traded funds (ETFs), have become increasingly popular with investors over the past decade or so. Originally designed to track a stock index, such as the S&P 500 index, ETFs have expanded and now track commodities, sectors, and so on. There are now ETFs available that offer an alternative to shorting. ProShares offers a unique breed of ETFs that are designed to go up when their underlying indexes go down, and vice versa. In other words, a long position is taken in the ETF while the market is declining because the ETF moves the opposite direction of the market. These inverse ETFs offer a solution to market participants who want to take advantage of a declining market but do not wish to short stocks or cannot do so in their tax-deferred retirement accounts. ProShares has introduced several such ETFs in recent years. The first inverse ETFs introduced correspond to the major averages. Traders have a choice of short or ultra-short ETFs. The ultra-short ETFs are designed to double the performance of the index. The short and ultra-short symbols for the market averages are listed below. Dow Jones Industrial Average, DOG and DXD, S&P 500 Large Cap Index, SH and SDS, S&P 400 Mid Cap Index, MYY and MZZ, NASDAQ 100 Index, PSQ and QID, Russell 2000 Small Cap Index, RWM and TWM. ProShares has since designed several more such ETFs that correspond to sectors and industry groups, such as DUG, that is the symbol for the ProShares Ultra Short Oil and Gas ETF. For more information on these ETFs, visit the ProShares website at www.proshares.com. Trading requires commitment. The markets do not hand out riches easily. The odds of winning are stacked against the novice trader. Becoming a successful trader requires persistence and discipline, and the willingness to commit to learning how the markets work. This book, because of its Getting Started in Focus, provides novice traders a foundation from which to get started with candlestick charting as well as Western technical analysis. If you wish to survive in this competitive business, be tenacious. Continue your study beyond these pages and develop experience through lots of practice with real-world chart analysis and trading. If you would like to pursue further training with me, please visit my website at www.tinalogan.com. I have dedicated many years to developing training materials and methods to help traders succeed. End of Chapter 10. End of book.
That's it for this video. Thanks for watching, and don't forget to like and subscribe for more updates and insights.